All right. Yes. Good morning, boys. We were, we were discussing about special tax regime in the last class, right? We tried to understand what is section 115 BAA and 115 BAB in the last class. We did a question also to understand what the whole format looks like also. Yes. Great. What we'll do is we'll come back and we'll revise what we have done till now, and then we'll take out from there. Yes. We discussed about what is called as rates of taxes, and then we went into something called as special tax regime. We got something called as Balaji. Oh, hi. Sit. Varamatana sonna? Yes, we were discussing about special tax regime along with the special tax of rates. The special tax of rate, we discussed about the fact that if you have an individual, you have something called as normal tax rates where you have 0 to 2.5, then 0 to 3 and 0 to 5 depending on what your age is. Then we went into default tax regime where we came and said it is 0 to 3, 3 to 7, 7 to 10, 10 to 12, 12 to 15, and after that above 15. This is what we discussed. Then we went on to say that if you are a poor person, then you will be eligible for something called as rebate under 87A. For old regime it will be up to 5 lakhs 12,500. For the new regime it will be up to 7 lakhs 25,000. 7 lakhs 25,000, but rebate is not eligible on something called as 112A. Then we went on said to that if you have any kind of rich person, then you are liable for something called as surcharge at the rate of 10% for income above 50 lakhs, 15% for income above 1 crore, 25% above income 2 crores, and 37% above income 5 crores. But if you are going under new regime, 37% is not there. The enhanced surcharge of 25 and 37 will not apply in case of 4 incomes: 111A, 112, 112A, and dividend income. These are the 4 incomes which will not apply. In case you are liable for surcharge, you are also eligible for something called as marginal relief. If you are under new regime, then you are also eligible for something called as marginal rebate. You are also eligible for marginal rebate. This is not there in your old regime. This is not there in your old regime. Then we went on to something called as companies, and we came and said that when it comes to a company, you have 2 kinds of regimes. One is called as old regime, one is called as special tax regime. Old regime comes and says that if you are a domestic company or previous year 22-23 turnover should be less than 400 crores, in which case you get 25%. If it is more than 400 crores, you get 30%. But if you are going under the new regime, then you have something called as 115 BAA and 115 BAB. BAA asks for a rate of 22 plus 10 plus 4, and the 115 BAB comes and says it is 15 plus 10 plus 4. But if you are having any income which is not incidental to the manufacturing, it is 22 plus 10 plus 4 without allowing any expenses. If you are having any short-term capital gains which is not eligible for depreciation, then it is again 22 plus 10 plus 4, but you can claim expenses. And then if you are going to have any kind of transactions with a closely connected person where the assessing officer feels you are excessive profits, you will be taxable at 30 plus 10 plus 4. 30 plus 10 plus 4. Other conditions to be satisfied, which we already discussed yesterday. If you are going back and you are checking for domestic companies, the domestic company surcharge rate in old regime is 0, 7 and 12. Up to 1 crore 0, after 1 crore to 10 crores it is 7, and after that it is 12. But the current year amendment comes and says that if you are a foreign company, the tax rate ends up becoming 35% with a surcharge of 0, 2 and 5. 0, 2 and 5. Yes or no? Yes, this is what we ended our discussion with yesterday. We also came and clarified a few things that Rahul, if your turnover is not available for 22-23, then it is assumed to be 30 as per ICA standards. It is assumed to be 30 as per ICA standards. And we also came and told that if you are a foreign company with the residential status in India, it still does not mean that you will be taxable at 25. You will continue to be taxed at 35 because that is what your rates for a nature are. Yes or no? Yes. Great. Moving on forward to the balance topics, the ones which are easy ones. We have something called as cooperative society. We have something called as cooperative society. Now, in all honesty, if you come and ask me, cooperative society is not a part of the person definition. It's not a part of the person definition. It is derived from something called as AOPs and BOIs. Yes, so it is not a part of person definition, but it is derived from AOPs and BOIs. The idea is very simple, people. Generally in India, a cooperative society is only created for the purpose of benefiting its own members. It is created only for the purpose of benefiting its own members. Charity is different, people. Charity is when you're doing it for the public. Cooperative society is a case where I'm collecting money from my own members and giving it back to my own members. Yes, as a normal practice, they call this as a principle of mutuality, where they come and say that when I'm collecting money from my own members and giving it to my own members, technically there is no income. Technically there is no income, and therefore there is no taxes. Therefore there is no taxes. Yes, that is what the whole idea is with cooperative society. And therefore income tax came and said that if you are anyway going to tell me that I am going to collect money from my own members and give it to my own members, tax is going to be 0. Tax is going to be 0. But then you are coming and saying, no, I will also do some other transactions. which will not be benefiting my members, which will not be benefiting my members. Here is where cooperative societies, they come and say taxes will now jump. Taxes will now jump because you were established only for the purpose of benefiting your own members. If you enter into commercial transactions, then it will become taxable at how, Rahul? They came and said from the first 10,000 rupees. From the first 10,000 rupees, tax rate will be 10%. Next to 10,000 rupees, tax rate will be 20%. Next to 10,000 in the above, it will be 30%. Meaning there is no basic exemption, people. 0 to 10,000 will be 10%. 10,000 to 20,000 will be 20%. After that, everything becomes 30%. That is what the whole model is. Okay. Meanwhile, I try to figure it out. The rates are on the screen, people. I am saying that when it comes to cooperative society, what is the tax rate? I am coming and saying that for the first 10,000 rupees, the tax rate is given as 10%. For the next 10,000 rupees, the tax rate is given as 20%. And after that, the last 10,000 is given as 30%. Yes. But then what happened is, people, cooperative society, normally you come and say that it is done only for the principle of mutuality, which means it's only done for the benefit of the members. Yes. But of late, what happened is one thing became very famous. One thing became very famous. We started talking about something called as cooperative banks. We started talking about something called as cooperative banks. Yes, that became a very famous thing right now. Now, if you and I understand very carefully, cooperative banks ideally come and say that they're doing it for the purpose of their members. But in all practical sense, they are nothing but a bank. They're nothing but a bank. And therefore, everything which a cooperative bank does is technically fully taxable. Yes. Now, here is where the problem came. The banks started coming and questioning, saying, sir, if I would have been a normal company, you would have given me a tax rate of 22, 25, 15 also for that matter. Yes or no? But just because I'm calling myself as a cooperative bank, because it's a cooperative society, you're expecting me to pay tax of 10%, 20%, 30%. Numbers are huge. Numbers are huge. Yes or no? Yes. Thereby, what happened is in 2021, they came up with a decision where they came and said, you know what? We'll extend the same kind of benefits which a company has to cooperative societies. We'll extend the same benefit which a company has to cooperative societies, and therefore they introduced something called as 115 BAD and 115 BAE. 115 BAD and 115 BAE, where they came and said that, you know what, if you are a cooperative bank, normally, if you are a cooperative society, normally this is what the tax rates are. But if you choose, you can go for the same tax rates as companies, which means if you are under 115 BAD, your tax rate will be 22 plus 10 plus 4. 22 plus 10 plus 4. But if you come and tell me you are a cooperative manufacturing society, then it is 15 plus 10 plus 4. 15 plus 10 plus 4. Every facts remain the same, no change in the facts. No change in the facts. Provisions appadiye copy paste. The only difference is that understand, people, when it's a company, you're liable for something called as MAT. You're liable for something called as MAT. But because it's a cooperative society, now it is liable for AMT. That is the only difference. So they came and said you follow the same rules as 115 BAD and 115 BAE, except for where you have MAT, you start using the word AMT. Full stop, khatam. Every other provisions are remaining the same. Every other provisions are remaining the same. So if you go to your study material, what they'll do, they'll take the whole 115 BAA and then copy paste into 115 BAD, and then they'll do 115 BAB and then copy paste into 115 BAE. Point is the same. No point of wasting time. Yes or no? Yes. Therefore, what I've done is I've not wasted time. I'm directly put everything up. If you go to the page number page number 26. I've completed everything in a single site where I'm coming and saying if it's a cooperative society, you need to look at what? If you're a resident cooperative society, you'll be eligible for an optional regime of 22 plus 10 plus 4, same as 115 BAA, and will be taxable at special rates for special incomes. Cooperative society in opting will not be liable for AMT instead of MAT. Every other provisions remain the same. You don't have any changes. You don't have any changes where they're coming and saying, Rahul, whatever benefits you can claim, you can ignore those benefits. Yes. Now, if you're a cooperative society, technically some benefits are not there itself for you. So therefore, I've just put it down saying that when you have to read the same benefits except for these items because these are anyway not applicable. These are anyway not applicable. So you can just ignore them. That's all is the point. Nothing else. Yes. Adhe Mari, if you go to 115 BAE, the BAE comes and says you are a resident cooperative society engaged in manufacturing operations on or after 1st April 2023. 1st April 2023, where they brought in the tax rate of 15 plus 10 plus 4, but other tax rates are also there, the 22, the 30, all the same tax rates. Wherever you see MAT, you'll change it to AMT, and then everything else remains the same. Everything else remains the same. This is what the tax rates are when it comes to your cooperative society. When it comes to your cooperative society. Any doubts still here?
This BAE does not have any sunset clause.
It is same provision. See, when I said same, I meant that the conditions were the same, and in my conditions I've put it that 31st March 2024 is your cutoff. So the same provisions of sunset clause on that also. Clear? Yes. Good to go. Good to go? Great. What we'll do is we'll quickly go through our materials for chapter number 2 and chapter number 3 and start marking a few things important for your exam purposes so that you don't miss it out. Shall we? Yes. Question chapter number 2. If you see from chapter number 2, it starts coming and saying, yeah, if you look at chapter number 2, it starts from saying tax rates of individual, HUF, AOP, BOI and AJP. We already discussed about what the tax rates are. Now from my side, I have already highlighted a few things. Yes, where I've come and told that if it's an individual, whether resident or non-resident, and then it is resident individual and resident individual. Just to clarify that if it's a non-resident, if it is a non-resident, the tax rates will move down to 0 to 2.5 lakhs. 0 to 2.5 lakhs. It's already highlighted, so you don't have to highlight it once again, but I'm just clarifying it once again for you. Yes, so please be mindful about it. In exam, if you get a question where they come and say it's a non-resident having 70 years of age, don't revert to 3 lakhs, keep it at 2.5 lakhs. Keep it at 2.5 lakhs, just bear that in mind. Next, we are coming and saying that Rahul, if you are a resident individual who is if you are a resident individual whose birth date is falling on 1st April, in that case, you will be assumed to have completed your birth date on 31st March and therefore will be eligible for higher basic exemption limit of 60 and 80 years ka cases. If your birthday is falling on 1st April 1965 and 1945, 1965 and 1945 ke tamari, you can change your birth dates. Then I've come and told that if you are a poor person who's having a total income up to 5 lakh rupees, you will be eligible for something called as rebate, 12,500 or actual tax payable, whichever is lower, but not eligible for 112A. Please mark the right side important. I'm coming and saying you're not eligible for 112A. 112A, please bear that in mind and please mark that important. Shall we? Yes. Next, you have something called a surcharge where I'm coming and saying the tax rates are 50 lakhs, 10%. After 1 crore, it is 15%. Then it is 25 and 37. On the right side, you will see that it is not applicable for 111A, 112A, 112 and dividend income. The topic of that is in the next page, so you don't have to worry about it. You can leave it go. And then I've told about the AOP provisions to you, where I've come and said if the AOP has all members only, then the rates will be same as companies. The rates will be same as companies. If AOP has all companies only, then in that case the rates will become same as companies for surcharge purposes. The same rates are given to you. One second, I'm sorry. Acha, they are giving you the same rates of individual, but they are not giving enhanced surcharge to you. Yes, my mistake. I'm sorry about that. Yes, then you have the provisions. This is the provisions which I was talking about, where you have enhanced surcharge, but not applicability for the 4 items. You can ignore all these people. Just read the table on the bottom, the summary part. Just read the summary part where I've come and clarified that if you have an income up to 2 crores, then you will consolidate everything and check for surcharge limits. But if you have an income after 2 crores, you will split and check for what is the surcharge limits. For dividend and everything, it will become flat 15. For everyone else, it will be minimum 15, and after that 25 or 37, depending on what your incomes are. Yes, please work. Don't screw my life. Get lost. Yes, then we discussed about what is a firm's tax rate. We came and said tax rate of a firm is 30% with a surcharge of 12% in excess of 1 crore. We have a company will be split into domestic company and foreign company. Please keep that in mind, that when it comes to 22-23, it is less than or equal to 400 crores. Sometimes in exam, they've given an MCQ question where correctly they'll touch on 400 crores. And you need to bear in mind that 400 crores exactly is also eligible for lower rates. I've already put it in the box, but nevertheless, please bear that in mind. Yes, and then you have an amendment of current year which says foreign companies 35%. People, it is hidden somewhere, like the green is not very clearly visible. So in case it is not, please highlight that also. Yes, please highlight that also, that foreign company is eligible for only 35%. Yes, and then the box is for your reference, where I've come and told you that if you're incorporated during 22-23, in that case you will have a tax rate of only 30% and not 25%. And then we are moving on to surcharge. Surcharge is 0, 7 and 12, 0, 2 and 5 for old regime, and then flat 10 for new regime. Cooperative society, first 10,000 becomes 10%, next 10,000 becomes 20%, and the final 10,000 becomes after that 30%. Your special rates are 22 and 15 as much as we have discussed for 115 BAD and BAE. Surcharge rates are 0, 7 and 12, same as companies, but if you are going under the special regime, then it becomes 10 each. Finally, we have something called as health and education cess, where they come and say health and education cess will be applied at the rate of 4% on the final tax payable, and then you have your marginal leave concept, where I've given you some illustrations, but the only part is important, which is this one. Where I've come and clarified that marginal leave will be applicable in case your
income is very close to surcharge changes.
Income is very close to a slab where the surcharge undergoes a change, meaning there should be a mandatory change in surcharge rate. If there is no change in surcharge rate, marginal leave will not apply. We have done some illustration questions also. Yes. My small request, people, when you are preparing for your exams, it is always a good exercise that when we have done questions and is relating to this, you put a note here itself somewhere. You can just put a note, refer page number so and so of your workbook, so that you can see the same question if you have a doubt. Yes, it becomes easier for you. That is why I've given the book where you can write page numbers and all. Yes, so put page number there, put page number here, give a cross reference, so that tomorrow when you go back home and you forget everything, you can at least look back where you have to check. Yes. Next, after marginal leave, we came and discussed about the fact that what is the special tax rates. We came and said your special tax rates are capital gains. Now, for me, if you ask me, this is the extremely crucial part. Everything else may also not come for exam, but this will definitely come for exam, especially because they have this very golden opportunity to test you before 23rd July and after 23rd July. So definitely expect questions around this. You can expect capital gains questions in exam, both parts, before also, after also. So please bear that in mind. It's extremely important for you from exam perspective. What is your 1128? It is 10% and 12.5% in excess of 1.25 lakhs. Option to choose whatever you want. It is more beneficial to opt for setting off against the post regime. Then you have 112, which is 20 and 12.5, and then 111 is 15 and 20. Then you have your casual income at the rate of 30%. Your online winning sort of formula we already discussed. Closing plus withdrawals minus opening minus deposits. People, you have a line here. Yes, can you note down here? In case the computation is negative. In case the computation is negative, you will ignore the same. In case the computation is negative, you will ignore the same. Done. Next, we had this transfer of carbon credits 10%, unexplained income is 60% plus 25 flat plus 4% cess, and then you have your royalty on patents and developed and registered in India. Like I said, you can opt for both. Either you can do 10% or you can do 80 QQB. If you do QQB, you will get a full deduction, but you will be taxable at slab rates. But if you choose to ignore that, you can do 10% and tax without any deductions. Conditions given to you: you should be the first inventor. 75% of the expenditure should be incurred in India. Opting the scheme is optional, but you have to choose it in the form. If you choose to opt in the scheme, you will have to be there for 5 years. If not, you will not be eligible for the next 5 years. And then if you are going for royalty income, then the same will be excluded from MAT computation because I'm giving you beneficial provisions. Yes, simple things. And then you have something called as virtual digital assets. Please bear in mind, I'm using the word capital gains, which means you are eligible for cost of acquisition. You are eligible for cost of acquisition, but nothing else. No other expenditure is allowed as deductions. Yes, all those notes are there in the next page, where I'm coming and saying if you are claiming expenditure, what kind of expenditure you can claim. Capital gains, any expenditure. Other incomes, no expenditure. But if it's VDA, you can claim cost of acquisition, and I'm using the word only cost of acquisition. No indexation benefits, no expenses benefit, nothing will be granted to you. Yes, ideally speaking, indexation is not there anymore, but in this year alone it is there because of 23rd July. Next year and all, I will remove this line also in our case because there will be no indexations anymore. Next, can losses be set off for capital gains? Yes, for others no, and for VDA also no. Like I said, if you are going to make a loss under VDA, again number will become ignored. Losses can be carried forward for the future. Again, yes for capital gains, no for anything else, because others cannot even have a loss. Then can you claim chapter 6A? This is where standardly everything is no. Please mark this as important. People generally tend to make this mistake where they end up claiming chapter 6A on capital gains also. Don't make those mistakes. Do not claim chapter 6A on capital gains. And then, can the benefit of basic exemption be utilized? This is your Kaju Katli. This is your Kaju Katli, where you can claim it for capital gains and not for anything else. Again, this is very important. Please bear that in mind also. Please mark this as important. This is only important in case you are doing double taxation, people. I'm very clarifying again. It is not for your companies and all because they don't have basic exemption limit. This will only be relevant when you do international transactions with me where we'll be doing double taxation. That time I'll ask you the same questions. That time we'll see if you remember or don't remember. Yes. Next, is opting the above rates optional? The answer is no for any except for royalty. Except for royalty. And then can you claim a rebate under section 87A? You can claim rebate on anything except for 112A as per study material and income tax act. As per ITR, you cannot claim on 1 money also in new regime, but that's a different conversation. Let's not worry about that. Right now, from an act perspective, you can claim on anything except for 112A. Finally, what are the surcharge rates? If you are under capital gains, and all surcharge rates are restricted to 15%, whereas anything else you will be taxable at the normal 0 to 37, except for unexplained income, which is liable for 25%. Liable for 25%. The next two things is something which a inter-student should know. And you should also keep in mind, please mark this also as important, that your total income should always get mandatory rounded off to the nearest 10 and the tax liability should be rounded off to the nearest 10. Do not lose this out. If you lose this out, you're not getting any marks. You're not getting. Headings on the top. A, B. Yes, people, this is a simple format for you to understand how a tax rate computation looks like. This is basically what we put in the golden rules also. Same thing which we put in golden rules, where we started from total income, did the taxes, did marginal relief, rebate and all those things, came to something called as rebate like I told you, and relief under 89. Relief under 89, this is your salary relief. And then you have total tax liability, remove your TDS credits, interest will be added, you will less your advance tax, self-assessment tax, updated return taxes, and all the final tax which you have will be rounded off to the nearest 10. Yes. Then we moved on to the next special tax regime where we spoke about 115 BAA and BAB. I told you in 115 BAA there is nothing great. You just have to tax it at the rate of 22 plus 10 plus 4%. 22 plus 10 plus 4%. This is what you will be taxing it for. Yes. And then we moved on to something called as 115 BAB. We moved on to something called as 115 BAB where we came and said you should be a domestic manufacturing entity. You should be a domestic manufacturing entity. You will be getting a special tax rate of 15% plus 10 plus 4. People, this table is important for an exam perspective. Yes. So please highlight the table and keep it as important. That is exam perspective important. See. Great. Moving on forward. Hey, when I say table, this is also important. Okay, this is more important. And then you have the conditions. Now, ideally speaking, if you ask me in the conditions, nothing really is being tested from exam perspective. Yes, because these are all old provisions now. They are already there since 2019. So ICS stopped testing all these things. This was more for our internal discussions in last class. You will not be expecting questions around this in exam. Yes, so don't worry about it so much. You can choose to ignore it. It's completely fine. Yes. Moving on to the special benefits and deductions. We will discuss this in the subsequent chapters. We'll discuss in the subsequent chapters. A small high level impression on what 115 BAA and BAB says about BAA and BAB says about in comparison 6. In comparison 6, more for your reference. Then you come to your 115 BAC. Again, only important from double taxation perspective. Only important from double taxation perspective. You will see the highlights. The highlights in green are your amendments. The highlight in greens are your amendments. So please bear that in mind. Then you have your rebate under section 87A with the tax rate continuing at 25,000. The tax rate continuing at 25,000. I've also put in a note here for your reference where I'm coming and saying rebate should ideally be restricted to 20,000, but somehow they're giving you 25,000 also. Yes, just from my reference purposes. And then you have your marginal rebate, which we spoke about. Yes, this I would normally say will be important from inter-syllabus perspective, not so much from final level. It's okay. It's okay. But yeah, it's there. So please keep that in mind. Yes. Next, we have something called as surcharge, where I've clarified that the surcharge of 37 will not apply. Surcharge of 37 will not apply. And then you have the balance things. Again, all these things will be discussed when we do the subsequent chapters. Finally, you have a cooperative society with 115 BAD and 115 BAE. BAD and BAE. You can choose to ignore it. If you want to remember, the best way I'll tell you to remember is remember company. If you remember company, cooperative is copy paste. Cooperative is copy paste. The same rates are giving. The only thing is section is different. The only thing is section is different. So might as well my recommendation, don't write the section number in exam. Yes, just complete with the tax rate and you can close the answer off. You don't have to write the section numbers in exam and you'll be easier, safe. You'll be easier and safe. Clear enough? Clear enough? Can we go forward? Yes, great. This is the end of your chapters of tax rates. This is the end of your chapter of tax rates, which is step number 9 versus step number 10. Step number 9 versus step number 10, whichever is lower, whichever is lower. Clear enough? Yes. People, before I go forward, any doubts with anyone? Pramin? The difference I would probably put it as companies are registered under Companies Act and gets a PAN number with C. Cooperative society gets a registration as AOP or BY. Right? So that's where the difference comes. And from an income tax perspective, like I said, right, what happens is if you register as company, you will be taxable as MAT. Whereas whereas a cooperative will be taxable for AMT. Ademari, whatever benefits you get as a specialized company, like for example, section 80M, intercorporate dividends, not eligible for cooperative society. Items like 35(2)AB, research and development expenses, all those items are only notified purely for companies. So it's a very conscious call you have to take when you register it. When you register a cooperative society, be very conscious about the fact that you're letting go some benefits. Yes, that is the one thing which you'll have to extremely bear in mind. Other than that, predominantly, I don't see a difference in today's world. If you ask me the same question 2 years before, I would come and say cooperative society had lower surcharge rates and all those things, so therefore it was rather beneficial. But then in today's regime, they have technically tried to make everything the same, at least from a tax rate perspective. From a computational model, things become changing. Yes. Now, if you ask me from a practical perspective, what is the difference? Companies, there is something called freely transferable shares. Yes, you have this policy of easily transferring shares and going forward. Cooperative society has no such things. Yes, you have to be very stringently a member, because only when you are a member you can transact in a cooperative society, otherwise you technically cannot do that. Yes, and transferring your membership to someone else takes a lot of pain. They don't generally do it. It's always supposed to be a closed circle, right? But then in today's world, that is also like very bleak, because now there is something called cooperative banks who's randomly giving money to any random person, right? The only difference they come and say is, if you get money from me, you're technically my member, only till the date on which you take it out. Yes, so that is the only difference. Yes, so there are light differences. From a tax perspective, I don't see envisaging so much great enough happening. Yes, anyone else, any doubts? No, comfortable with the chapters? Yes. My small request, what will I tell you? Revise it once again. See if you are able to understand and appreciate this. Yes. Now I have some questions from ICI standards. It's ICI standards, so you know how the questions are. Yes, I'm not going to be doing that so much. I'm going to show it to you and you're going to quickly tell me what is exactly going wrong. We've already discussed the basic level questions, right, about your diversion of income and application of income. We have discussed all those. Look at the question. It says, question number 5, Arjun has a total income of 16 lakhs for the previous year 24-25, comprising of income from house property and interest on deposits. Hey, all the incomes are general incomes. All the incomes are general incomes. They're asking you to compute tax liability for 25-26, assuming his age is 52, 64 and 83. What is this? What is this? This is your basic tax rate question. This is a basic tax rate question where in the first bracket you will be taxable at a slab of 2.5, second you will be taxable at a slab of 3, and then you will be taxable at a slab of 5 lakhs. Assume that Arjun has exercised the option of shifting out of default regime, meaning it's going for alternate regime, and therefore you have to do all the 3 slabs. Simple basic question for you to tingle yourself. Yes. Next, compute the tax payable of Mr. Abhinav, aged 32 years, meaning normal 2.5 slab. Has the following incomes given to you. They're coming and saying the interest on fixed deposit is 1,10,000, interest on savings account is 15,000, consideration received for transfer of VDA is 62,000, cost of acquisition is 21,000, and expenses on transfer of VDA is 1,000 rupees. Notice the total income carefully, people. What will you do? Interest on fixed deposit is SBI, taxable at slab model, Interest on savings bank with SBI, taxable at slab model, but you are eligible for a deduction called as section 80 TTA. You are eligible for a deduction called as 80 TTA up to a maximum of 10,000 rupees. Then you have a consideration received from VDA of 62,000. This is your special incomes. Will be taxable at the rate of 30% after granting only cost of acquisition. So you will reduce the cost of acquisition of 21,000, thereby arriving at an expenses for transfer of 0. Yes, expenses for transfer become 0, which means your incomes are now 1,10,000, 5,000, 41,000. You have your incomes, you'll have to total that time and you will get your total income. Can you tell me what is the total income? What is the total income, people? 1 lakh? 1 lakh 20 plus 41, 1 lakh 61,000. Correct, no? One lakh 10,000 plus 5,000, how much? 1 lakh 15. 1 lakh 15 plus 40, 1,000, how much? Hey, 10,000 TTA da. I asked total income only now. 1 lakh 56,000. This is what your tax is. Yes, now if you understand this carefully, Rahul, 1 lakh 56,000 technically means you are less than basic exemption limit, so tax rate should be 0. Correct? No? No, you have a BDA income. You have a BDA income, which means all other income will be taxable at 0. BDA will be taxable at 30%. I told you already, Kaju Katli only applies for capital gains, does not apply for BDA and all those things. Yes, so you cannot claim Kaju Katli on BDA, therefore it will be taxable at 30% along with the cess of. You will get a rebate. You will get a rebate and then be taxable at 4% and then be taxable at 4%. Now let me tell you one thing very honestly, in this question rebate is not there. In this question rebate is not there. Somehow ICA, when they drafted the question, they forgot to give a rebate. They forgot to give rebate, and so therefore in this question the answer of ICA comes and says you will be taxing the whole thing at 30% plus 4% cess, plus 4% cess, which is completely wrong because you are eligible for rebate. You are eligible for rebate, you should be able to claim the rebate. Yes, so what will you do? You will tax the 41,000 at the rate of 30%. Number comes as 12,300. Now here is where the question is. The question does not say whether I want to go for old regime or new regime. If you go for old regime, then it is reduced 12,500 plus cess. But if you go for new regime, it will become 0 because you get a rebate of 25,000. You get a rebate of 300. Acha, okay. So in 12,300, you will get a tax of 0 because eligible for rebate, and new regime also will get 0 because the rebate is 25,000. So technically tax is 0. But then in this answer, if you notice, they'll come and say that the person will be paying taxes of 31.2% on 41,000, which is wrong. Which is wrong. I'm just clarifying this to you. Yes, it is not there in the syllabus like that. You are eligible for rebate. You should definitely claim for the same. You should definitely claim for the same. Clear? Yes, you cannot do hand picking items and all where you can come and say one thing I'll not give you rebate, other things I'll give you rebate. Rebate is eligible for everything except for when it's an explicit clarification, everything else is eligible. That is what the whole premise is. Clear? Next, compute the income tax payable by Mr. Siddhant, age 24 years, who has the following incomes for the assessment year 25-26. I'm giving you the salaries of 8,40,000. Interest on savings is 12,000. Again, eligible for 10,000 80 TTA. Number becomes 2,000. Consideration received for VDA transfer is 50,000. Cost of acquisition is 5,000. You will reduce both, get a number of 45,000. Mr. Harish is also employed with ABC Bank. Who's Harish here? Acha, Harsh. Okay, two different people. One is Siddhant, one is Harsh. So Siddhant is transferring the VDA to Harsh. Siddhant is transferring the VDA to Harsh. Now there is a person called Harsh who is employed with ABC Bank on a monthly salary of 50,000 rupees. Additionally, this person has an interest on savings bank account with India. Mr. Siddhant has not exercised the option of shifting out of 115 BSc. Ignore the TDS provisions. Basically, why this is given is because in TDS chapter, you learn that when the person is given to another person, there are some restrictions. It's not important. Right now, we will not focus on it. We'll focus when we go to TDS chapter. Right now, the question is only from Siddhant perspective. From Siddhant perspective, what will you do? You'll say income is 8,40,000 plus 2,000 plus 45,000. The person is falling within the slab of middle class. Falling within the slab of middle class. Therefore, you'll choose whether you want to do old regime or new regime and compute taxes accordingly. Yes, here you will not be eligible for any rebates. You will not be eligible for any rebates. Yes. Sorry. Oh, it's given. Achha, I'm sorry. Okay, it's given. Mr. Siddhant has not exercised the option of shifting out of default regime. When I say not exercise the option of shifting out, it means the person is under default regime. The person is under default regime. Sometimes they'll play like this only. They could have might as well told what? The person is paying tax under default regime. They could have said the person is paying tax under default regime, but they're saying he's not exercised the option to not shift out. Two knots become one positive. Two knots become one positive. Playing around with English, people, nothing else. Please read the English carefully. Like I said last time, section numbers are not important. English is more important. This is an English where they're coming and saying the person is going for default regime. Adhige tamari, you'll have to compute your taxes. You'll have to compute your taxes. Clear enough? Yes. Then compute the income tax payable by Mr. Raj, age 32 years, was given the following incomes to you. The person has a business loss of 3,18,000. The person has an interest on FD of 18,000. Consideration of given of VD of 4,20,000 and the cost of acquisition is given as 20,000. First, what will you do? You will reduce 4,20,000 minus 20. So consideration for VDA becomes 4 lakh. Now here is where the question is. You have a business loss. You have an interest on fixed deposit. You can set off, not set off. Can you set off, not set off? You can, because this is current year losses. This is current year losses. Current year losses can be set off against any head other than salaries. Assuming if the question said this is a business loss of past years, then you cannot set off, because past year losses can be set off only against business income. Can be set off only against business income. Again, further discussion in set off chapter. But right now the provision is because it is current year losses, you can set off against IFRS income. So technically what is going to happen? 3,18,000 will be set off against 18,000. So you will get a zero income. You will get a zero income. Loss will become 3 lakh. Can you set off that loss against VDA? Can you set off the loss against VDA?
Yes or no?
Can you set off the loss against VDA?
Yes.
No, you can't. No, you can't. VDA provisions, I told you, is similar to your unexplained income and winnings. Is similar to your unexplained and winnings, and therefore losses cannot be set off against the same, which means you have to end up paying taxes on VDS. You have to end up paying taxes on VDS. Check here. As per section 115BBH, business loss cannot be set off against income from transfer of VDA, which means the 3 lakhs cannot be set off against VDA. You will have to carry forward for a period of 8 years, with the restriction that you will file your return of income on time. With the restriction that you will have to file your return of income on time, which means the only income which will be left for the current year is your VDA income of 4 lakh rupees. Question, Rahul, now your basic exemption limit is 0. Can you adjust against basic exemption limit? No, you can only do it for 3 capital gains, which is 112A, 112 and 111A. This will not be adjusted against your basic exemption limit, meaning on that 3 lakh rupees, on that 4 lakh rupees, you'll have to pay tax at the rate of 30%, but you are eligible for rebate, which is not given in the question. Which is not given in the question. You are eligible for rebate. You should be able to claim the rebate and then add the cess on it. Add the cess on it. Clear? Clear? Sure? Yes?
So they are not setting it off because it's VDA. If it was other capital gains, it will
If it is other capital gains, business loss can be set off against any head other than salary. So therefore, you will be permitted the set offs. Because it is VDA, you are not permitted the set offs. Clear enough, people? Good to go? Good to go? Great. This marks the end of your chapter number 2 and chapter number 3. Chapter number 2 and chapter number 3. This questions and all we will discuss, people, not right now. We will do it after we complete the heads of incomes. Yes, we'll do it after we complete the heads of incomes. Then only you'll understand. Yes, so let's not do it right now. We'll discuss it later. Great. That brings us back to the other things. I think we have a break at 9:30 something. Yes. So what I'll do is I'll spend another 30 minutes trying to complete your unexplained and agricultural, and then we'll move on to the review of financials. Because yeah, I'm not able to work this out, so I can't review the financials without using this. Yes. So right now I'm just going to take you these things, and then we'll go back and come. Yes. See, ideally, if you honestly ask me, I'm not very interested with these chapters, because before I start itself, I can tell you none of this is coming for exam. But nevertheless, it's a part of the syllabus, so let me just discuss it quickly. Yes, we're looking at a very, very small chapter, which is normally in your ICI study material, part of chapter number 1 itself, called as taxation of unexplained income. This is a chapter which is basically coming and telling you, what do you call as unexplained income? Because the moment you call something as unexplained income, it is now going to become taxable at the rate of 60 plus 25 surcharge plus 4% cess, totaling up to 78%. Yes. Now, if you read the line carefully, it says taxation of unexplained income. So normally a person would come and say, Rahul, we are only discussing about incomes which are not explained. We're normally discussing about incomes which are not explained, but that is not what the premise is. This chapter basically comes and says that, Rahul, any item which you have, when I say any item, I mean any item. It can be investment, it can be cash, it can be assets, it can be money, it can be income, or it can be expenses also. Income tax comes and says, no matter what item you have, you should be in the position to explain the source at any given day. When an assessing officer comes to you and comes and says that you have an item, tell me what is the source of income, you should be able to justify the source. If you are able to do it, great. Then I will come and say, okay, you are a good assessee, genuine assessee, I don't have a problem. The day when I come to you and ask you for source, if you are in a position to not explain me the source, If you are in a position to not explain me the source, assessing officer will come and say, boss, something looks wrong. When you don't even know where the source is coming from, it means the source is black money. The source is black money, and therefore you would have ideally not paid taxes on this in the past. You would have ideally not paid taxes on this in the past. Therefore, I will take the opportunity to tax it today. I will take the opportunity to tax it today with an additional benefit that I will tax it at 78%. With an additional benefit that but benefit for assessing officer, not for him. With an additional benefit that will be taxable at 78%. Yes or no? Yes. So if I have to cover this chapter in a nutshell for you, the chapter is very simple. In exam, if you get a question, where the question comes and says, assessing officer has asked to explain the source, and the assessee has not explained the source. Assessee has not explained the source. You don't have to worry whether it is an income, asset, expense, investment, doesn't matter. Just look for the word called explanation of source. Explanation of source. If you see this line, you will have to ask yourself whether, Rahul, it is unexplained or not unexplained. If you see that the explanation is not granted, it is unexplained income, taxable at 78%. Taxable at 78%. This is basically the nutshell of the chapter. Nothing else is there in the chapter. Yes. Now, let me also be honest about this chapter. If you notice the chapter, it starts with the word where the assessing officer, which means I am coming and telling you that, Rahul, this will be taxable only when the assessing officer identifies. This will be taxable only when the assessing officer identifies, which means in all practical sense, this chapter will only apply at the stage of assessment. Will it apply at the stage of return filing? No. Do you think anyone voluntarily will go and inform someone that I am doing unexplained income, therefore tax at 78%? Will not happen. Yes. So this whole chapter only applies during assessment stage. So it has nothing to do with your computation of total income chapter. Which means when you prepare your income tax return, you will never come and disclose this. Yes or no? Yes or no? Now this is what you and I understand. But this is not what income tax ICA understands. Yes. I have seen exams questions in the past where suddenly what will happen, ICA will throw up a question on you. And they'll come and say, the person has done so and so transaction, explanation of which is not available. You are at what stage? Return filing stage. If you are at return filing stage, even if you don't know explanation, will you voluntarily go and inform? No. But ICA, what will do? ICA will come and put a note saying, because the source is unexplained, this is an unexplained income. And therefore, they will tax it at 78%. When? Return filing stage itself. People always come and ask me one simple question. Rahul, 25% surcharge. Why exactly is that having a different surcharge? Why can't we put 37 on it? Yes or no? What is the logic of having a 25% flat surcharge? The idea is very simple, people. Income tax department comes and says that these are all incomes which may not be pertaining to current year alone. Because I am also talking about your prior year assets. I am also talking about your prior year expenses. So I am going to tax this as a separate transaction. I'm going to tax it as a separate transaction, independent of your normal incomes. Yes or no? Now, when I'm going to tax it independently of your normal incomes, do I care what your normal income is? No. Which means what I'll do, when I pass an assessment order, I will pass an assessment order in two parts. Part number 1, what you declared. Part number 2, what I identified. Part number 1, I'll come and say you tax as per what you want. And part number 2, I will come and say flat tax at. That is what the whole idea is. Yes or no? Yes. So the whole chapter of section 68, 69 and everything has been brought in with the intention that assessing officer alone can tax it at the rate of 78% only at the stage of scrutiny assessment. Has nothing to do with assessees. Yes. But in exam at certain point of time, they have brought in this weird questions where they come and say, no, assessee itself wants to voluntarily declare at total income level. Don't do it. Yes, you are one of the most smarter CAs I know. Yes, if you itself go and tell your client that come declare unexplained income in your return, he will first stare at your face and then he'll stare at our degree. Yes, don't do that. That's not how it works. The section itself is very clear to that extent. So you don't voluntarily come and make a disallowance. Are you clear? Yes. Of late, ICA has realized this mistake. And when I said that May 24 inter-syllabus, correctly same question came. They are asking unexplained income and total income question. Yes. So I don't tell nowadays itself that ICA is being smart. At least at final level, they have become smarter. Yes. In the sense that in final level, now they don't bring it as a part of total income question. They now ask it as a theoretical question. One of the questions which I gave you in the past, where what happened is there is a person who is having a building for which he paid rent of 1 crore. The question comes and says the person has paid a building rent of 1 crore rupees. Assessing officer has reached out and requested for the source of the expense. The assessee was able to justify the source only to the extent of 10,000 rupees out of 1 lakh out of 1 crore. Sorry, okay, then able to justify only 10 lakh rupees out of 1 crore. Out of 1 crore. Assessing officer has proposed that the differential 90 lakh rupees should be treated as unexplained income. The assessee has proposed that even if the income is treated as unexplained income, since the expenses were used wholly and exclusively for the purpose of business, he would like a deduction of the same. He would like a deduction of the same. Discuss and confirm whether the action of the assessee is correct or not correct. It is not correct. What will you come and say? As per the provisions of section 69C, when an unexplained expense is identified by the assessing officer, the source of which is not explained satisfactorily, the unexplained income will be treated as, the expenses will be treated as unexplained income for the assessment year 25-26. Further, the same section also comes and clarifies that you are not permitted to set off any expenses against the corresponding income, and therefore the 90 lakh rupees, despite being incurred wholly and exclusively for the purpose of business, will not be allowed as a deduction. Will not be allowed as a deduction and will be taxable at the rate of 60 plus 25 plus 4, effectively becoming 78%. 4 mark small question for your exam purposes. Yes, these kind of questions you don't need to read with me, people. You just have to look for that word called as source and explanation. You have to look for the word called as source and explanation. You see the word explanation, you know that you are going for unexplained incomes. That is what the idea is. Are you clear? Yes. Let me take a second and I'll quickly show you what the topics are. I'll quickly show you what the topics are, only to come and tell you what the headings are, because everything else you already know. Yes. What is the idea? I'm coming and saying you should either not explain the source, or you explain the source and he is not satisfied. He is not satisfied. Simple, straightforward English you'll see in every topic. Rebate and basic exemption definitely cannot be claimed, because basic exemption can only be claimed against capital gains. Coming to the rebate part, if you come and ask me, I would say yes. I would say yes, but technically the answer is no. Yes, the reason is because, like I told you, unexplained income is going to be taxed at assessment stage. And when it's going to be taxed at assessment stage, it is going to be taxed independent of your total income. So when it's anyway going to be taxed independent of your total income, assessing officer has no obligation to give you the rebate. Yes, if you ask me from an ICA perspective, I would say yes. When I say ICA perspective, in the sense that if ICA is voluntarily telling disallow it and offer it to tax, then I'm putting it as a part of my total income itself. Now, the moment I'm putting it as a part of total income, I am definitely eligible for it. So there's no doubts there. Yes. So it all depends on whether you're going to add it to your total income or you're going to show it separately. If you show it separately, I don't see the reason to give you the rebate, but if you're adding it, I will give it to you. If it's this, why would you disclose an ITR? So here is what happened, right? If you remember the question which I discussed with you last class, I came and told you about 2 scenarios. Scenario number 1, where you have put the expense and then assessing officer is asking for source. In which case, what will you do? You will disallow and add. Second is the case where I come and told you it's not there in the books itself. In that case, what he'll do? He'll directly add, right? So it's not just about what is here in the books. It is also about telling what is items otherwise. Yes, the point, like I told you, it's all about what items you have. You can have any item, whether it is there in the books or it is not there in the books. Both are covered in the syllabus. Yeah. Let's look at the topics and let's understand what are the topics. First item, if you notice, it says cash credits. People, English. What is cash credits? When you open up your books, you found some cash coming in. Assessing officer will ask you for source. You have 2 options: either explain the source or don't explain the source. Don't explain the source. If you don't explain the source, assessing officer will treat it as income. If you explain the source, there are 2 options. Assessing officer should be satisfied, not satisfied. If he's satisfied, great. If he's not satisfied, unexplained income. Yes, how do you write the English, people? Where any sum is found in the books of account and the assessee offers no explanation, or the explanation offered is not satisfactory, the income is unexplained income. You will see these 2 lines same in every heading. Nothing is changing. Yes, next. Unexplained investments. What is unexplained investments, Rahul? I have investments which I have not even disclosed. Meaning a raid happened in my house. Assessing officer found that I have assets. He's coming and asking me, tell me where is the source. I am telling him, sir, I don't have the source. He will treat the investment as an income. He will treat the investment as an income. You may come and ask, Rahul, investments is of past periods. Investment is of past period. Then what will happen? Income tax officer will come and ask you, tell me which year did you buy the investment? Which year will you buy the investment? If you tell him a year, he will open up that book and he will tax it. Meaning he can backdate and tax. He can backdate and tax because it is better for him only. He will get additional interest on it. So he will backdate and tax. But if you don't explain in the year of investment, he will assume it is of current years. He will assume of current years, presumption of taxation. Presumption of taxation. They will come and say it is investment of current year. They will tax it in the current year. Third item, unexplained. What am I talking about? I have some money which is not recorded. But when I use the word money, I mean every other item of money also, like bullions, all those items, precious article, everything is covered. Any other item which I have not recorded in the books of accounts will be called as unexplained. Money will be again taxable for 78% after they find out that the person has not offered explanation or the explanation offered is not satisfactory. Yes. Next, you have something called as partial disclosure of investments and money. What is this? What is this, people? Now I have disclosed the item in my books of accounts, but the item is not making sense. There is this very famous thing in Chennai, people. If you remember, there was this very famous politician we had, Amma Jayalalitha. Yes, at a certain point of time when she was about to die, there was a big raid at the house of Sasilata. And what they came and found out, they opened up the drawers and everything, cupboards and everything, and they found chappals. But the chappals are done with diamonds, rubies, emeralds and all those things. Yes or no? Yes. The question which was asked, this Jayalalitha at that point of time was only taking 1 rupee per month as salary. She was taking 1 rupee per month as salary. She came and said, I want to do only good for India. Therefore, I only take a salary of 1 rupee per month. In 1 rupee, she bought diamonds. Put them in chappals also. Yes or no? Now imagine a scenario where what is happening? She has the books of accounts. The books of accounts will show only chappal with an investment of 1 rupee. Because that is what she has in her hand. But actually worth of the asset is in crores. Yes or no? Now at this point of time, no one should come and say that, sir, understand, you came and told that only if it is undisclosed investment, you will tax it. There is a disclosure, just that the number is wrong. In order to ensure that that kind of shenanigans are not played, they introduced section 96B, where they came and said, boss, even if you have disclosed, the value should be explained. So I will look at the market value, and if the market value is explained for the source, then I will give you the benefit. Otherwise, I will tax the differential. That is what I came and told you, right? If you have a 10 lakh ka justification out of 1 crore ka payment, I will take a tax only on 90. I will not take a tax on full 1 crore because 10 lakhs is justified. Ade mari, if you are able to explain, then you will be explaining and he will be satisfied. To the extent he is satisfied, he will not tax, balance everything he will tax off. That is called as partial disclosures. Yes. Point number E, unexplained. What is this? You're talking about payments made. Two options. Either it can be payment made and recorded, or it can be payment made and not recorded. Both are taxable. If it is recorded, you will disallow and tax. If it is not recorded, you will directly tax. Yes or no? Yes. Last item is called as hundi. People, any idea what is this hundi? Any idea, people, what is hundi? The Tirupati. Sorry? Bill of money. Pool of money. Meaning, give me a practical example. That's cooperative society. People, you remember this movie called Shivaji the Boss? There will be one scene where what will happen is he'll call up all the politicians and he'll come and say, 50 mera, 50 tumhara, nahi to pura government ka. Yes, 50% of the black money is yours, 50% of the black money is mine. Everything is going to department. And then he'll go to a factory, he'll put all the money, and then suddenly the supporting actor will come and say, now what? And he'll say, I'm traveling to US. When he goes to US, he'll go to that person and he'll show a bill the 1,000 rupees ka note. He'll look at the serial number and come and say, yes, you are only the right person. And in exchange, he'll give you dollars. In exchange, he'll give you dollars. The 1,000 rupees is called as hundi. The 1,000 rupees is called as hundi. Hundi is basically a negotiable instrument. Hundi is basically a negotiable instrument basis which you can enter into transactions. Under Negotiable Instruments Act 1882, until a certain point of time, hundi was a legal transaction. Hundi was a legal transaction until it started getting used for black money and terrorism. Black money and terrorism. That is the day negotiable instrument came up and said that, Rahul, this will all become illegal, and therefore under Negotiable Instrument Act they declared all hundi transactions as illegal transactions. All transactions as illegal transactions. Hundi is nothing but a negotiable instrument which is given to you for you to take money. For you to take money. A classic case of hawala transaction. A classic case of hawala transaction. How many of you understand this word called hawala? What is the meaning of hawala, people? Imagine a case where you are a terrorist planning to bomb India. Planning to bomb India. Obviously, what you will not do? You will not bring guns in an airport. What will you do? You will travel normally in India. You will travel normally in India and you will come to India. You want guns now. You want guns now. What will you do? You will go to a dealer and come and say, I want guns. I want guns. Obviously, dealer will say, give me money. Give me money. Now, you travel to India. You never carried money, because if you carry so much money, people will ask you. People will ask you. So, what will you do? What will you do? You will call your friend sitting in another country and come and tell him that you pay him in that country. Yes or no? So what will you do? You will call your friend in that country and come and say you pay him in that country. And then the person who receives the payment will call the gun dealer and come and say, I have received the payment. I have received the payment. Hand over the guns. Hand over the guns. The person who's collecting the money there is called the hawala person. Is called the hawala person. All these transactions are happening based on hundi. The money which was given from there, he will transfer it to this person by a negotiable instrument. Because what he'll do, he'll collect US there. And somehow make a transaction here in India. All this is promoting terrorism. That is when negotiable instrument decided that it becomes an illegal transaction. Income tax brought in an amendment and came and said, going forward, when you enter into a hundi transaction, when you know that the transaction is illegal, then the transaction will directly be deemed as an unexplained income. Notice the lines, one thing very carefully, people. Whenever you did something called A, B, C and D, they always started with this word called as offers no explanation. Explanation offered is not satisfactory. Meaning, I gave an opportunity to the assessee to justify. Read unexplained income. What does it say? Where any amount borrowed, repaid is received other than by account pay check, amount borrowed shall be deemed to be the income. Meaning, there is no explanation. You enter into a transaction, you are gone. It is an unexplained income, full stop. Meaning now I am not even giving you an opportunity, because negotiable is told it is illegal. And therefore you very clearly are doing an illegal transaction. I don't need to give you an opportunity. I will directly take the money and tax it at 78%. I'll directly take the money and tax it at 78%. That is the kind of powers. If you enter into a hundi transaction. The only benefit they're giving is that you should not do hundi transactions by account pay check. Obviously, no one is going to do that. Because if you do an hundi transaction by an account pay check, you're technically giving a demand draft. If you're doing a hundi transaction by account pay check, you're doing nothing but a demand draft. What are you doing? You're taking a note and going and giving to him and coming and saying deposit in your account. That is what you call DD. Then it is not hundi, then it is DD. Correct? No. Yes. Therefore, they came and said, boss, if you're doing account pay check, everything is happening through bank account. Now I can catch you. Therefore, that is not illegal. Illegal is all about talking. Other than account pay check, like straightforward cash only, nothing else. No one else is going to give you check and all. They're going to give you cash only. Correct? Not correct? Yes. At the same time, please understand, Rahul, they're coming and saying it will be taxable at two instances. One is at borrowing, other is at repayment. Whichever I find out, both are taxable. Rahul, but if one person is taxable on borrowed, will he be taxable on repaid? No, because you cannot tax the same income twice. So they're coming and saying one person on borrowal, one person on repayment. If both are going to happen to the same person, I will tax either of the two. Whichever I find out earlier. Correct? Not correct? Yes. This is your very simple chapter on unexplained incomes. Nothing complicated about it. The one thing which I probably wanted to clarify to you people is that there are some amendments in this. Not in the current year. It has changed over the years. change over the years. Let me take a simple example. I'm coming and telling you that Rahul, there is a credit in your account. There is a credit in your account. You have received money. Let's say you are a firm. What are you? You are a firm. Partners have put money into the firm in the form of capital or loan. In the form of capital or loan. Who's using the money? Firm is using the money. So assessing officer came and asked the firm, dear firm, tell me what is the source of this money. What is the source of this money? The firm came and said the source is partners. Who is going to justify this? Partners only. So partners are coming to assessing officer and coming and saying this is partners' money. Meaning the person standing in front of him itself is the person who has put the money. So assessing officer comes and says, okay, tell me where did you get the money from? Where did you get the money from? He says, sir, I am today representing firm. I am not representing myself. I am not representing myself. As a firm's capacity, I will come and say, I don't know. Because this is partner's money. If you have a problem, ask partner. Don't ask firm. Correct? Not correct? Yes. Stupidity. I am standing in before of him and I'm telling it is my money which I put in the firm, but I will not explain the source because I am now not a individual. I am a partner to a firm. I'm a partner to a firm. You have a problem, go check with the partner. Go check with the partner. Now obviously assessing officer knows if he's doing this all, it means it is a illegal transaction. And therefore what he did, he ended up taxing the whole income in the hands of firm. The firm ended up filing an appeal. The firm ended up filing an appeal and went and told the court that, sir, this is not my money. If you want to know the source, ask partner. Don't ask the firm. Don't ask the firm. What did court say? Court said correct, not correct? Correct. Court said correct, which means it is not taxable in the hands of firm. It is not taxable in the hands of firm. If you want, go and ask the partners. Go and ask the partners. Now here is where the problem happens. If you understand this practically, people, assessing officer of the partner and the assessing officer of the firm will be same different people. Will be different people. So what happened? The person who lost the case is the assessing officer of firm, but he never referred the case to the partner, which means technically what happened? No one got taxed. No one got taxed. Correct? Not correct? Yes. When all these problems was happening in India, that is when an amendment came in the act. That is when an amendment came in the act. The act was amended to the extent where they came and clarified that if the firm is now receiving money from the partners, the firm will have to justify the explanation of the source. They cannot use a defense that the firm money is of the partners and so partners will justify. Firm will have to justify the explanation for partner also. If the firm fails to explain the source, it will be taxed in the hands of firm. It will be taxable in the hands of firm. But it seems bad, right? Who did illegal transaction? Appa, who's being taxed? Looks bad. Yes. They also put in a second defense where they came and said it is okay. I will tax in the hands of firm. Firm is now responsible to go and collect it from the partners because it is your partner. You take care. Because it is your partner, you take care. I want my money. I want my money. You have a problem, go to your partner and come and say, I've paid tax on your behalf. Therefore, you will have to give it back to me. You'll have to give it back to me, but I will not let you take a defense on that. I will not let you take a defense on that. Yes or no? Yes. So this was amendment number 1 where they came and said that even if the owners put in money, the company or the firm can be asked to explain the source. And if the company or the firm is not able to explain the source, then in that case, it will be taxable in the hands of company or the firm also. It will be taxable in the hands of company or the firm also. Now, why I am using the word companies because income tax clarifies the same rules apply for a closely held company. The same rules apply for a closely held company. People, closely held company means company in which public are not substantially interested. Company in which public are not substantially interested. Examples: public company, unlisted public companies, but it's going to be a subsidiary of public company, right? There's no thresholds. It comes and says if you are a government company holding more than 51%, then it is not a company in which public are substantially interested. You should not be a public limited company. You should not be listed company. You should not be holding of a public company also. You should not be holding of a public company. I don't know what is unlisted public company. Shares are not listed. Who's holding it? Who's holding it? So you have termed yourself as a public company, but you're technically leading private placements. Point is, people, public invest substantially not interested are those kind of people which are not government companies, which are not listed companies, and which are not holdings of public companies, which are not registered under a special act, in simple technical sense it is private companies. Unlisted public, if you ask me in honest sense, it is also private company only. Yes, so therefore they are also covered. These are all the companies where income tax is come and clarified that when they receive share capital, company can be asked to explain the source of owner's share capital. If they are able to justify, then great. If they are not able to justify, it will be taxable in the hands of company also. Now here is where the problem starts. Imagine 200 shareholders you have. An assessing officer comes and asks you to explain the source. You will have to go ask every shareholder to tell me what the source is to get the money back. Huge mistakes. Very difficult process, but unnecessary powers given to them. And that's how the whole model works. Clear enough? Yes. A simple chapter on your unexplained incomes. Any doubts? Can we go forward? Yes. Great. This moves you to the next chapter called as, by the way, before we do that, I've already clarified this. You will be taxable at the rate of 78%. This is all something we have already discussed in the tax rate chapter itself. You will not be granted any expenses or losses. You will not be given any basic exemption limit benefits, and you will not be granted any carry forward of losses. But if you are doing an unexplained income, people, income tax now also has the authority to levy something called as penalty at the rate of 10% on tax payable. Please be mindful of this. It is 10% of tax payable, meaning 78% kamala 10%. It is 78% plus 10%, which is 7.8, which is 85.8%. It is not 88%. It is not 78 plus 10. It is 78 kamala 10. There will be some chapters where you learn it is 10% of income, and some places you learn it is 10% of tax. So please be very mindful about it. It is 10% of tax here. Clear? Yes. While it is not there in this chapter, let me also clarify to you. If at all there is an unexplained income which is from a source outside India, this chapter will not apply. Because then you have another chapter called as Black Money Act. Where they come and say that if you have an unexplained income from an outside India source, the tax is 30%. Which means it is good to have assets outside India versus assets in India. If you have an asset in India, it is 78%. If you have an asset outside India, it is 30%. That's how the stupidity is. But it is there as it is. Clear enough? This is your chapter called as unexplained income. Any doubts? Can we go forward? Yes? Great. Let's do a review, a high level review of how you should be looking at a financial statements when you start preparing your computation people. Yes, I always tell this one thing. There are two kinds of tax people. Yes, one is the person who files the return, and one is the person who prepares the return. Yes, normally as an article you get an option to do only one. Yes, the point when you start moving to option number 2 is when your principal is somehow felt like, okay, this person is doing a good job. Yes, that is the day when you can somehow feel proud that the principal knows you. Before that, every time it's only like, Rahul, I will prepare the return, you go and file the return. Preparing an ITR6 is one of the most shittiest job in life, no doubts about it. Yes, it is the day when you come and feel defeated because there's nothing else happening. You will sit and you will bug everything into the ITR6, and then everything you press, the moment you press validate, it will come and show runtime error gone, and then you start over again. So I always tell people that, first year articleship, okay. Second year articleship, you should be in a position to prepare the computation, and then you give it to your juniors and let them figure out the runtime error. Right? That is where the fun is, because now if you have prepared the computation, they will not expect you to complete the return. Your job is done. Right or not? Yes. So therefore, I always feel that this is a more interesting thing to do because it gives you an overview also of what the company is people. Yes. There are two things to do in the computational financial statements. One thing is to first of all understand what the business is about. Yes, before even you understand what the business is, you can never do a computation. Yes, keep that in mind. There is one mistake which I've seen in most of the qualified CAs when it comes to tax computation is that they have a certain section numbers in mind. They'll be like, okay, standardly finance is 43B, 40I, computation. Yes, that's not how it technically works. It is extremely important for you to first understand what is the nature of business also. What is the model of business? Transfer pricing model of the business. All these things are extremely crucial for you to understand before you take over decisions. Yes, because sometimes those smaller mistakes which you make in that is where the whole answer lies. Yes, and therefore one thing which I always recommend any computational professional to do is to first go and talk to the people. Understand from them what their business is doing. Learn from them what the model is. Right? I'll give you a simple example. There is this one company which I have, and complete offshoring entity. A complete offshoring entity. Do you understand what is an offshoring entity? What is an offshoring entity, people? Any idea? Sorry? Outside India ka? Offshoring entity is basically an entity created in India only for the purpose of providing services to group companies outside India. Only for the purpose of providing services to group companies outside India. For example, one of my companies, his name is ROS. One of my company's name is ROS. Company's business itself is to only do support for my group companies. Do support for my group companies. Now, if you understand this very carefully, when my company is only going to be supporting group companies, it means the company's complete revenue model is based on transfer pricing provisions. Complete revenue model itself is based on transfer pricing provision, because every single transaction the company does is all going to be transfer pricing affected. Transfer pricing affected. Now, here is where the point is. You have two options. You can take the financials of my company and you can start making disallowances. You can start making disallowances. Option number two, before even you start, the first thing you will come and ask is, because this company is full transfer pricing entity, have you first of all file करके क्या करेगा? Have you first of all done what? Checked for the margins. Have you first of all checked for the margins? Because understand, if it's an offshoring entity, they would have been having a predetermined margin. Yes or no? Let's say, for example, in my company, the predetermined margin comes and says that for whatever cost I incur, 10.5% is the margin. 10.5% is the margin, because my company is a management entity. My company is a management entity. Now, first thing what I'll do the moment I know that, I'll first of all look at my P&L. I'll first of all look at my P&L at number level or percentage level. At percentage level, I'll look at my net profit, compare it with my costs, and find out whether the margin is coming as 10.5 or not 10.5. Because the moment I see that the margin is coming more than 10.5, I'm okay, not okay. I am okay because I'm earning more than what I'm required. But the moment I hit a margin of 9%, do you think I can go forward? Do you think I can go forward? I cannot go forward itself, because my margins are not satisfied. Yes or no? At this point of time, you preparing a competition will make no sense. Will make no sense, because you have first itself not even completed the accounts in a proper sense. You have not completed the accounts itself in a proper sense. Now you may come and ask me, Rahul, this is anyway taken care in transfer pricing. No. Understand, people, the moment you are an offshoring entity, even Companies Act comes and says that you should prepare accounts on an arm's length basis. On an arm's length basis, which means the moment you are doing anything less than 10.5, first of all, auditor itself has to come and qualify the opinion. Auditor itself has to come and qualify the opinion and come and say in the audit report that the company is not satisfying the arm's length margin as per Companies Act as well, and therefore the financials are not appropriate. The financials are not appropriate. The moment you see that itself, you know that before even you go into competition, there is already a disallowance, which is the differential 1.5%. The differential 1.5%. Yes or no? Now, if you look at the P&L, will you be able to identify that answer? Will you be able to identify that answer? No, it's not there, because it is coming from a whole study, and the whole study is coming based on the nature of business, and the nature of business will only come when you know what is the business. Yes or no? Yes or no? There are two kinds of ways to approach a financials, people. One is called as what is there in the books, and one is what is called outside the books, and one is what is called outside the books. Things which are outside the books are more complicated, because that's where the whole magic happens. Yes, the small things which you miss outside the books is what you never have an answer on. And the two ways where you will find the answers to outside the books is where, first, from the management team, after you understand the nature of business. Second is from the last year's return. Example, for example, you have a disallowance of 40i in the last year. What is disallowance under 40i? TDS disallowance. Yes. Now, if it's a disallowance of TDS of the last year, will it reflect in current year's P&L? No, it will only reflect in the TDS return. After you know the TDS return, only you can claim a deduction, which means it is not there in the financials itself. But if you don't remember all those things, will you be able to claim it? No. Same example, last year's return has losses. Will it reflect in the current year's return? It will only reflect if you take the last year's return. Yes or no? Yes. So always the last year data is a good basis for you to start. And the one problem with most of the people is they will take last year's return, copy paste all the computation. Standard CA policy. They will not look at anything. No business, no nature, no nothing. Now, last year you made 5 disallowances. This year I made 5 disallowances. How? Last year I would have linked to the FS. So current year when I update the FS, it will match the same number. And then you will come and say, Rahul, I'm done with my work. Give me 1 lakh rupees for the return filing. For the return filing. I literally throw these people out. I've sent mails, I tell you. I've sent mails. I've written this big of a mail and I'm coming and saying if I had to do a linking of my financial statement, that is what I prepared and gave you. What the hell am I paying you 1 lakh rupees? My article can do better than you. Correct, not correct? Yes. Use a little bit of head, people. That is what the more important part is. Yes. The small agendas, the small issues which you identify, that's where the whole change happens. That's where the whole change happens. Yes or no? Yes. Now, unfortunately, in this FS, I don't have the audit report. So I'm assuming it's a clean report. I'm assuming it's a clean report. That is what I am feeling. Yes. Anyway, let's go from the top. Let's go from the top. I'm looking at the financial statements right now. Yes. I'm going to look at items one by one. I'm going to note down section numbers. You're going to note down the same section numbers. If you also know, if you don't know, you will first tell me that. You'll first tell me that. Yes. Two-way approach, people. I will read a line item. You will tell me if you think something is wrong. You will tell me if you think something is wrong. And then I will tell you if you have missed out something. Yes. Now, as of my policy, I never look at the balance sheet. I never look at the balance sheet because it makes no sense to me. It makes no sense to me. I will look at the notes on the balance sheet. Yes, I have to look at the balance sheet, but not on the heading level, because on the heading level, it makes no sense. Everything has a note. Everything has a note. So the first thing which I do when I look at a balance sheet is that I will look at every item and I'll check if every item has a note. I'll check if every item has a note. If every item has a note, then I look at the notes. I will not look at this. But if there is no item with a note, then that's where the whole problem is. That's where the whole problem is. Looking at it quickly, share capital has a note, reserve as surplus has a note, long-term borrowings has a note, deferred tax liabilities. Hey, deferred tax liabilities important, not important? For what? You will find it on the P&L also. Yes, long-term borrowings, deferred tax liability, short-term borrowings, state payables, other current liability, short-term provisions, everything has a note. So we will discuss it later. Next, you have your current assets, your non-current assets, long-term loans and advances, other non-current assets, investments, inventory, trade receivables, cash and bank, short-term loans and advances, other current assets, everything has a note. I don't have a problem. I don't have a problem. So I'm going to ignore this and I'm going to move to the P&Ls. I'm going to move to the P&Ls. Now, normally, if you notice, P&L also has a note. P&L also has a note, but it's a good exercise to always look at the P&L to make some decisions. So I'm looking at the first item, which is revenue from operations. It has a lot of income. We'll discuss in the notes. So it's okay. Then you have other incomes. Now, I would like to know what are my other incomes, because two things will happen. First, I will know what head of income to tax. Second, I will also be able to find out whether it's a revenue receipt or a capital receipt. Because it's a revenue receipt, I will tax it, but if it's a capital receipt, I can claim a deduction. So two things are going to happen here. We're going to hold the discussion. Next, you have something called as cost of materials consumed, standard expense. Now you have purchase of stock in trade, standard expense. Then you have changes in inventories. This is a closing stock minus opening stock, no problem. Employee benefit expenses, we have a note number. We'll discuss in the note number. Next, finance cost, depreciation, I will disallow. So the first thing I will come and do is, the moment I look at depreciation, I will take a disallowance for depreciation, because it has to be done as per Income Tax Act. This is not allowed. Section number 32. Done. Next, you have other expenses. Now this is where the critical part is. This is what I have to look at very seriously. But this is what the P&L looks like. After the P&L, I'm looking at something called as current tax, deferred tax. I'm looking at current tax and deferred tax. Question: when you prepare your Pgbp statement for the purpose of income tax, you will start from profit before tax or profit after tax? You have an option to start either ways. I would tell you that if you are preparing a MAT computation, always start profit after tax. Both the normal and MAT also. Because MAT computation comes and says that you should start net profit after tax. And therefore, if you start from net profit before tax, somehow your ITR 6 will not match. You will end up in more disallowance in MAT computation, and your statement which you prepared versus MAT computation statement will not tally itself. The reason is because tax is getting disallowed twice. So I always recommend that if you're doing a MAT computation, always start from net profit after tax. But if you're doing a special regime, then always start from net profit before tax. Small recommendation from my side. Yes. After that, you have some items called BEPS, which is your ஏன்டா வந்துனே இருக்கு அப்படியா சிச்சோ போச்சு நாளைக்கு பாப்போம் yes we are looking at profit after tax, and then you have something called as BEPS. Now BEPS is just a computation, so I don't have a problem. But one good thing which I notice in this financial, I am noticing something called as tax related to previous year. Looks weird. Looks weird. I don't know what tax related to previous year is. This is technically prior period taxes. This is technically prior period taxes. I have not read the financials, but on a high level, I can tell you what is this. Yes. Imagine an example where what has happened is assessment year 23-24. You would have prepared a tax computation. You would have prepared a tax computation. And when you prepared the tax computation, you realize you missed out a few expenses. Or you missed out to offer extra income. You missed out to offer extra income. What you will do? You will put it in the computation. You will put it in the computation, but you will not put it in the accounts because accounts is already audited. Accounts is already audited. Now here is where the problem happens. Understand, your tax computation will show more tax compared to your accounts. So what you need to do? You need to create more provision. You need to create more provision. So what will happen? You will go and inform your account team that in my tax I have paid 100 crores, whereas your accounts is showing only 80 crores. So put an extra 20 crores. Put an extra 20 crores. Now accounts team will come and ask you whether it's provision of current year or last year. You will say it is last year's provision. You will say it is last year's provision, which means he'll come and say it is last year's provision. It cannot impact my current year. Therefore, I have to show a different disclosure. I'll have to show a different disclosure. Therefore, they'll put in an extra line item called as tax related to prior years. Tax related to prior years. This is option number 1. Option number 2. This normally happens in case of transfer pricing adjustments. This normally happens in case of transfer pricing adjustments, where what normally happens is you will prepare your computation as per normal. You will go for assessment. Assessing officer suddenly put a transfer pricing adjustment on you, and you have decided to accept. Now, when you decide to accept, the tax is going to be pertaining to that year or pertaining to past years. Yes or no? You would not like to have that income showing in the books right now. And therefore, what you'll do, you'll pass a separate line item called as tax relating to past years. See, technically, you're anyway going to disallow. But this also now gives you a hint to understand what is wrong with the business. Now, I don't see a note number, but there will be a note number. When you read the note numbers, you'll find this out. The reason this is extremely important is now you know that the company made a mistake in the past, which the company has identified. What is your job? To ensure that the same mistake does not happen this year. Yes, which means before you send out your query sheet, you will also take this into mind, and you will come and say in the query sheet that, sir, this is something which has happened in the past. Tell me if it is there in the current year also, so that you don't make mistakes there. These are all some strategies to follow. Can we go forward? Yes. Now I am done with my P&L also. This brings me to something called as cash flow statement. Yes. Now the cash flow statement, technically, if you ask me, is not important. It's not important because all these answers will come from P&Ls, but there are some items I personally look into cash flow. The first item which I look into cash flow is something called as purchase of plant, property and equipment. Because this now comes and tells you what is going to be the additions value in your depreciation schedule. This is going to tell you what is the additions value in your depreciation schedule. Now, while it is not there in this cash flow statement, there will also be one item called as sale of PP. And for me, this is the most important thing in cash flow. Because if you understand this carefully, people, in accounts, what happens when an asset is sold from the block? What will you reduce? You will reduce the WDV of the asset, but depreciation of income tax requires you to reduce sale value. Yes. Now here is where the whole problem comes. When you want to reduce sale value, you will go to the accounts team and come and say, give me what the sale value, and normally they will not have an answer. Whereas you technically actually already have the answer, because it is there in the cash flow. The sale value which you get here, you just have to take the sale value and put it in your depreciation schedule, which means a good checkpoint is when the tax audit team, the stupid accounts team which you don't trust on, yes, when they prepare a depreciation schedule and give you two things to check: purchase price should match with the depreciation schedule, sale price should match with the deletion schedule. If it does, then the depreciation schedule was prepared properly. If it is not, send it back saying it is wrong. This will help you understand where the sale value is coming from. Yes, the one thing which normally people forget to understand is that what to be reduced from a depreciation schedule is the sale value, not the WDV. And therefore 99% of the times, even in Deloitte, I'm telling you, Deloitte also has come back, completed tax audit and given me a depreciation schedule where they have reduced the WDV itself. And I've sent it back to them saying that if you are like this, then what the worth are CA for you? Yes, either you could have given it to tax team itself, we could have done it better for you. What is the point of you coming and calling it tax audit and therefore doing it an audit when you don't know tax? The audit is not important, the tax is important. Forget that first. Yes or no? I've sent it so many times. And the worst thing is we show a wrong face to the client. Because for them both are same only. They are not going to be worried about whether you're a tax team or audit team. Now you cannot send a mail to them saying, yeah, tax audit team made a mistake, go and ask them. Because they'll come and say, hey, it's your team only, go and ask yourself. Yes or no? It'll have a Big Four has a stupid policy. I don't know what kind of stupid policy they have. They have this policy that once they have signed the document, they'll never revise it. They will never touch it itself. I've done so many times. They literally came to a person. I don't mind. I have the company so I can tell. Yes, there was this one tax audit report which was prepared once. Yes, and in the tax audit report, the question was asked is whether you are making any transactions under 269 SS. 269 SS basically comes and says you should not make cash transactions more than 2 lakh rupees. Because if you do so, you'll be levied penalty. You'll be levied penalty. Question came and said, have you paid any transaction in cash? And there was a drop down. Yes or no. You should select. You should select. No. Idiots selected. Yes. Now this was a disclosure, so it doesn't matter. It doesn't matter. But you filed a tax audit report showing, yes, I got the tax audit report. I went and I showed them, dude, what the hell? Why did you put yes? Why did you put yes? Because you know the moment you put yes, what will happen? One straightforward notice will come from department and come and say, the tax auditor is coming and declaring that you have shown all this in cash. Therefore, please pay penalty 100% of the tax, 100% of the sum. Whatever cash you did, 100% I want right now. 100% I want right now. I went and told them, boss, 2 days before only you file the tax audit. Do one small request. Revise it off. Hey, are you permitted to revise a tax audit? Yes, ICI itself comes and permits you to revise a tax audit. They came and said, no, Big Four policy, we cannot revise a tax audit. We cannot revise a tax audit. You made a mistake. I know. Appa, what is the solution for this? We will prepare a, and the shitta solvanga, what is that idiotic thing called? MRL. We'll prepare a partner representation letter and we'll give it off to the client saying that this is hereby certified from Deloitte that we have inadvertently put yes instead of no. We have verified it from our side that the person has entered into all transactions by account, paycheck and nothing by cash. Therefore, the person is compliant under 216 SS. They gave this as a statement to client. And I said in the statement, yes or no? Yes or no? They gave this statement. They gave this statement. Month later, what happened? Notice came from the JCIT. From the JCIT, he sent a notice saying your tax auditor has declared saying you have paid everything by cash. Therefore, please surrender 100% of penalty. Please surrender 100% of penalty. The client did what? He took the document, submitted. He took the document and submitted. The JCIT told what? Your tax auditor at one form is coming and saying you're wrong. And another form is saying, yes, tell me whom did you pay money to get this form? Tell me, whom did you pay money to get this form? I don't trust the certificate. Do what? Bring your whole bank statement. Bring your whole cash book. Bring your whole financial statements. I will verify. I will verify. They launched a special audit. They launched a special audit. New CAs were appointed who were going and verifying the whole company's books. Who were verifying the whole company's books. They went and spoke to every single person and asked, did you get cash? Did you get cash? Did you pay cash? Did you pay cash? They sent notices to all our other companies, the transactional people. Everyone they sent a notice asking, give me a confirmation that the person has not done any cash transaction with you. It went for 3 months only to give back confirmation that yes, the company is compliant. Unfortunately, they somehow found that yes, the company has paid some cash transactions. The only difference is instead of paying 400 crores, they paid 1 lakh rupee. 400 crores penalty. அசிங்கம் இல்ல எனக்கு கேட்கிறதுக்கு அசிங்கமா இருந்தது தெரியுமா? The client did what, you know? Client did what, you know? Next year said we don't want audit from you itself. Straightforward. We lost a client. And the problem is the client was a part of a big group itself. We lost 8 clients For one yes, and that one ego. 8 clients I tell you, yes, and that was my biggest client. That biggest client, because of which what happened is I lost all my revenue. Obviously I was an article, so I don't care. Yes, but I lost all my revenue. My manager lost all the revenue. And because my manager lost all the revenue, what is the next thing you will come and say? You didn't achieve your target. Therefore, tata bye bye. Yes, my manager was thrown out of the company. Straightforward out. Because biggest revenue lost, retainership gone. Yes, we were making about 5 to 6 crores from that guy. All lost. Single shot, just for one yes. And who made the mistake? Start team made the mistake. Who got the hit? We got the hit. We lost our jobs. We lost our things, people. Yes, I always started doing the next thing. You know what is the next thing I did? Next year, Lenda, I told all my tax auditors that bloody if you sign the tax audit without getting my confirmation, I will not touch the audit itself. Yes, I wrote a mail to my partner marking their partners. And I wrote a mail to everyone saying, if I get a tax audit next year without my confirmation, we will openly come and declare from our side that we are not signing any reports. We will not do a computation itself. We will ask them to go and do a computation from somewhere else. It went from my partner to their partner also. Imagine. And I was an article. Yes, that is the first day I wrote a mail to my partner. And you know Deloitte and all. You cannot write mails to partners and all. Yes, I wrote a mail to partner personally. Because I lost my manager. One of the beautiful managers I had in life. Yes, she literally trained me for the 3 years. And then suddenly one day they're coming and saying, target not achieved, leave from the company. Yes, the kind of insult we went through. I wrote a mail to the partner saying, this is what happened in our company because of one stupid mistake which the audit team did and they decided not to modify it. You know what happened? This mail went to our Deloitte CEO of India. Obviously, it went to the CEO of India to come and say that this is not a policy we should encourage because we are losing clients. And when money is involved, no policy is important. Yes or no? Yes. Then the CEO wrote back a mail and they gave a confirmation saying if the mistake is identified within a matter of 1 or 2 months, please encourage revisions. Yes. If Deloitte CEO of India is coming and saying after the group has left. Point is, people, one small recommendation which I always make is that when you are also given the responsibility to do a tax computation, don't jump and do a post-mortem job. You're also responsible for the pre-audit. Yes. So be an active involvement discussion for the tax audit part also, because sometimes you never know, you may make better suggestions because you are the experts there. Yes, that is what the whole premise is. Clear enough? Yes. Story is not important, but yeah, when I am angry, I'm angry. Yes. That is how things go. Anyway, after that, Rahul, what exactly are you looking from here? I am not technically looking at anything else. I'm not looking at anything else. The one other thing which I'm looking for is something called as dividend payment. If it is there, I'm not sure. It is not there in this company, but I'm looking for something called as dividend receipt. I'm looking for something called as dividend receipt, and I'm looking for something called as loan receipt. And I'm looking for something called as loan receipt. Tell me why, people. Sorry? Yeah, ATM. Okay, one thing. Next. I am looking for something called as deemed dividend. Section 222E. Yes, the moment you see in this financial statements that someone has taken a loan or an advance, the next question you need to ask the clients is that where did you get the loans and advance from? Did you get it from your holding company? Did you get it from your holding subsidiary company? Sorry, did you get it from your subsidiary company, or did you get it from your shareholders, or did you get it from a beneficiary? Did you get it from a beneficiary? All those things will be checked in order to decide whether it's a deemed dividend taxable under IFOS also. Taxable under IFOS also. That is also one important thing to do. Yes. The next thing why I'm looking for dividend receipt is because in case you have taxed deemed dividend in the past, and then you have decided to issue dividends, then it will not be taxable. Then it will not be taxable because the provision comes and says when the money is already taxed in the past and then adjusted against dividend, it is not taxable right now. It is not taxable right now. So these are some things which I check from a cash flow perspective. Small things to keep in mind. Obviously, I'm looking at the company has accumulated profits. $105. Yes, so I'm looking at 222E from here. Clear enough? Clear enough? This is your basic understanding of cash flow statement. Can we go forward? Can we go forward? Yes. Next. Rahul, what starts from here is your notes to accounts. What starts from here is your notes to accounts. Now I'm looking at what is my shareholders funds. I'm looking at what is called as shareholders funds. One thing which you can realize from shareholders funds, people. Why do you have to look at shareholders funds? For why?
No.
270 BF. Acha, premium. That you look in premium. I'm talking about share capital. Very good. Yes, there are some Supreme Court decisions which have come and clarified that if you have decided to increase your issued share capital, whatever expenses you incurred against it will become a permanent disallowance. So the one thing which I always look for is when you look at share capital, I will look for whether there is any further issue. Second thing, I will also look for something called as buyback. Or I will look for something called as reduction. Because reduction will become taxable under dividends. Buyback will be taxable under buyback tax. You are looking at last year. Assessment year 23-24, 24-25 we're doing assessment year 24-25. Buyback was taxable as buyback tax. In 25-26 it has become dividends. But I am looking at last year's financials. So therefore it is buyback tax to check. And then if you have an issue of share capital, you are looking for issue expenses. Now notice people, issue expenses will not be there in the P&L somewhere. You will have to ask and get it. The moment there is an increase in authorized share capital, you will have to write a mail to the CS of the company. And come and say that boss, whatever is the ROC fees, tell me where is the money. You will take the money and you will disallow the whole expenses. Correct. Next, I'm looking at something called as reserve and surplus. Now, I think reserve and surplus sort of breakup will be given somewhere else. So I'm holding the discussion. Then I have something called as long-term borrowings. Any relevance? Double taxation for long-term borrowings. Any notes, people? Any idea why long-term borrowings? For loans and borrowings. To that extent, okay. Long-term borrowings, if it is from a shareholders and all, it will become 222E, which is what we already gave. Anything else? For what? We'll get in an expense. No, P&L में check करेंगे. यहाँ पे क्या important है? Any relevance here, people? No? Why? How does it matter? It's a loan with cash. What does it matter? As long as it's not a hundi transaction, I don't care. It will not apply for. That is for 20,000. It's a disclosure thing. And anyway, it's a penalty thing. It's not computing and affecting your taxes. Next. No. There is this one thing which I realized from one of my articleships, people. Generally, when you get a loan, you get it for the purchase of assets. Sometimes what you don't realize is that the loans which you have got is technically used for qualifying assets. And thereby comes in the provisions of borrowing costs. Where they'll come and say that when you have taken a loan for the purchase of assets, this will now come and tell you when the asset was put to use. That will help you decide whether the asset you should claim depreciation or not claim depreciation, and whether the interest should be capitalized or not to be capitalized. A small hint comes from here. So it's always good to ask, why did you take the loan for? If you took the loan for an asset, then you will come and ask whether the asset is under use or not under use. That also helps you determine whether the asset should be eligible for depreciation or not eligible for depreciation. Yes, so a small hint for you to check. This is something which I call as borrowing costs. Coming to deferred tax liability. Now, if you honestly ask me, I don't think it's important. Deferred tax liability basically gives you a hint how the tax team of the company has prepared a computational mechanism. Yes, for you it is not important. If they can do it themselves, why would they come to you? Therefore, it is not important. I would choose to ignore it. Next, short-term borrowings. Again, from the perspective of loans and advances, deemed dividend. From the perspective of loans and advances, deemed dividend. Coming to trade payables. Again, we'll discuss all this in the specific notes. We'll discuss in the specific notes. You have other current liability, short-term provisions. All these, we need to understand what it is. So, therefore, we'll discuss in the notes. Next, you have assets. You have assets, something called as tangible asset, intangible asset, and CWIP. This is what I was talking about. This is what I was talking about. CWIP assets are not eligible for depreciation because the asset is not put to use. Because the asset is not put to use. So you need to ensure that this should not form part of your depreciation block. This should not form part of your depreciation block. You should not end up claiming any depreciation on this. Yes. At the same time, if there is CWIP, you should also bear in mind that there may be loan against CWIP. So whatever interest you get from the loan should be capitalized because of borrowing cost standards. Yes. So again, CWIP gives you a hint of borrowing cost. Borrowing cost. Yes or no? Yes. Then brings it non-current investments. Now technically for 23-24 it is not important, but in the past, whenever there was a non-current investment, I always used to come and ask people whether there is any dividends. Whether there is any dividends, because in the past dividends was exempt from tax, and therefore non-current investments was used for the purpose of computation of Rule 8D. Rule 8D, Section 14A. Section 14A, where you have to do expenses incurred in relation to exempt income. Expenses incurred in relation to exempt income. For that it was important. Yes. Right now the only reason I would look at it is probably to check whether you have any investments in partnership firms. You have any investments in partnership firms. Why, Rahul? Because if the profits are exempt from a partnership firm, any expenses which you incurred for the purpose of investments or any going forward expenses, you will have to disallow under Rule 8D. Rule 8D. So this is more for the perspective of Rule 8D. I'm sorry. Rule 8D. Clear? 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 This brings in your long-term loans and advances. Now, from your perspective, it is not important because you have given a loan and advance. You have given a loan and advance. It is not important. In the past, this was important because that time it was dividend distribution tax. So when it was DDT, that time it was important. Now it is not important. I would choose to ignore it. I would choose to ignore it. Next, you have other current assets. All these details we'll discuss in the notes. We'll discuss in the notes. People, you're following, making sense of what we are doing? Yes. Going forward. Yes. Now starts your computational mechanisms. What are we looking at the disclosures, Rahul? First thing I'm looking at, if there is any increase in authorized share capital, I'm looking for issue expenses. If there is any increase in equity share capital, I'm looking for issue expenses. These are both capital in nature and therefore permanently disallowed. Permanently disallowed. Coming to your sorry? 56? That will come only when you have a premium here. Let's wait. Yes, reconciliation of share capital is not important. And then you're moving to shareholders. You are moving to shareholder detail. Why is important? For you to check your deemed dividend, you need to check who's holding more than 10% holdings. Yes, if there is a 10% holding, only deemed dividend is important. If there is no 10% holding, I don't care itself. So that is one thing to be checked in mind. Second thing, why I always check this is that if you have a non-resident parent, all these issue and everything which you happen will also be regulated under transfer pricing. And therefore you will need to comply with transfer pricing provisions. To that extent also I will check this. Clear? Next. Hey, one other thing which I always check is that I always check for movement in shares. Yes, because what happens is, understand people, there is a shareholders which you are given. Yes, one thing which I always ensure is that shareholders and this shareholder should remain the same. Because we have a section called as Section 79. Section 79 comes and says that when you are making losses, you should ensure that the year in which you made losses versus the year in which you are planning to set off the losses, the shareholders holding 51% should remain the same. So if the moment I see a difference in shareholders, I will have to go and ask, do I have any pending losses? If I have a pending losses, all the losses are lapsed. Section 79 is critical for you to keep in mind. Manav. Clear? Yes. Also bear in mind that, Rahul, Section 79 only applies in case you have any business loss. It does not apply in case you have any unabsorbed depreciation. Unabsorbed depreciation can continue to carry forward. You don't have a problem there. Clear? Yes, moving on forward, we have reserve and surplus. We have a reserve and surplus. Now here is where things become a little complex. Yes, notice the first thing which I'm noticing in reserve and surplus is something called as securities premium. The first question I'll ask is, the moment I have a securities premium, have I issued any shares at premium this year? If I issued any shares at premium this year, if yes, then I will be liable for something called as section 56 to 7B. 56 to 7B. Now, let me also put a disclaimer to you people. 56 to 7B is only applicable for 24-25. For your attempt of exams, this has been scrapped. This has been scrapped, so it is not there anymore. It is not there anymore, which means from next year, I don't care. From next year, I don't care. From next year, if you do a issue of share capital at a premium also, it is okay. It is okay. It is only till this year that it is liable. Yes, so for your financials of current year alone, you'll check it. Next year, you will not check this. Clear? Yes. Next, you have anything called as surplus. Now, this will come and tell you whether you have losses in the year. Whether you have any losses in the year or you have any losses of the past, because you will need it for the purpose of MAT computation. You need it for the purpose of MAT computation. Under MAT computation, for those who understand this, provisions of MAT come and say that you can set off book losses or book depreciation, whichever is lower. Book losses or book depreciation, whichever is lower. There they don't look for income tax losses. They look for book losses. So therefore, this is applicable from MAT perspective. This is applicable from MAT perspective. Clear? Yes. Third thing which I check is for something called as amalgamation reserve. Is something called as amalgamation reserve. Why am I looking for that, Rahul? Any idea, people? Any? When it comes to amalgamation, people, the provisions of income tax come and say that when it's an amalgamation, you need to be a manufacturing entity in order to carry forward the losses of the prior entity. In order to carry forward the losses of the prior entity. Because this is a manufacturing entity, I would look for an amalgamation reserve to check whether there is any losses of the prior entity. Because please understand, that is an out of book adjustment, people. Yes, when you are doing losses of your books, you will have to know whether there is losses in the prior books. For you to know that, there should be an amalgamation taking place, and the only way you can find out is by having a amalgamation reserve. Yes, when you have an amalgamation reserve, you will check whether the older company had any losses. If they had any losses, then you look for section number 72 AA. Very good. It is 72 AA. You look for section 72 AA, where you will come and check for any losses of the amalgamated company getting amalgamating into us. Getting? It is 72A or 72 AA. One of them is amalgamation, one of them is demerger. Yes, one of them is amalgamation, one of them is demerger, whichever it is. Yes. If you are a service industry, then whatever losses which were there in the amalgamating company gets permanently lapsed. So those things you will know from here. Clear? Yes. Next, you're moving on to borrowings. Now, Rahul, I already discussed about borrowings with you. I'm coming and saying that when you have a borrowings like this, the one thing which I look for this is unsecured borrowings. If you notice unsecured borrowings, you now have a unsecured borrowings from related parties. What is the implication, people?
Interest paid on both 48 to B.
Very good. You will look for 40A to B. You look for 40A to B. Provisions coming and saying that when you take in borrowings and all, and especially when it's unsecured, you will need to ensure that the expenses interest is within market value. If it is higher than market value, then the expenses get disallowed. Notice, I am only looking at it from the perspective of borrowings. I am not looking at it from the perspective of advance. Meaning, I receiving an advance of borrowing companies, I am okay. Because 40A to B only applies in case of expenses. Does not apply in case of incomes. Technically yes, but normally a person would keep that in mind. Yes, because it is your job to go and inform the client that yes, there is a mistake which you have done. You can expect a risk against it. You won't make a disallowance against it, but it's a good sign to tell them about it, right? Because at standard basis, what happens is that a person may not think about it. A company may end up paying interest, let's say 14%. Yes, and the benchmark which ideally income tax uses is the ideal benchmark which income tax uses is SBI interest rate as on 1st April. They use the SBI interest rate as on the 1st April. So they will check it with the SBI interest rate as on 1st April, and if it is anything lower, they will end up making a disallowance. So it's a good exercise to at this point of time go and tell the client that please confirm what is the SBI interest rate as on 1st April. If the SBI lending rate as on 1st April is higher, then you are safe. then you are safe. But if it is anywhere lower, then you are at a risk. Take in mind because assessment in the question varum. Assessment in the question varum. Clear?
SBI lending rate of 17 loan. Purpose SBI lending rate only they check the.
That is for employees.
That's for
It is also used for 40A2B. I am telling the best benchmark which generally an assessing officer uses is that rate. There is no rule against it. There is no rule against it. When you go to transfer pricing, you'll find a rule. When you go to transfer pricing, you'll find a rule. It's not here. Transfer pricing, secondary adjustment has a rule against it, but that is not in income tax. Yes, so you'll find it there. Understand, people. It is also that if you're giving this loan to a foreign person, if you're giving a loan to a foreign person, then they'll not use SBI rate. Then they'll use LIBOR. They technically end up using LIBOR. Now that LIBOR is abolished, they're using alternate rates. I'm just giving you an reference, people. Yes, so basically they'll end up using LIBOR rate. The only difference is when they use LIBOR rate, they'll use 30th mid of the year. They use the mid of the year. When SBI rate, they'll use 1st April. When LIBOR they use the middle of the year. We will discuss all this in transfer pricing. I'm just giving you a hint about it. Yes. Next, what else do you see? Deferred liability, I'm going to ignore. One thing which I'm noticing in the deferred liability is now you have a MAT credit, which means they are indirectly coming and telling you that the person is claiming MAT credits, which indirectly also gives you a sign that the person has not opted for 115 BAA, 115 BAB, which means the person will now have to do computation under normal and MAT. You'll have to do a computation under normal or MAT, whichever is higher. If MAT becomes higher, you can claim the MAT credit. If the MAT is not higher, then you will continue with the. I'm sorry, if the normal is higher, you will claim MAT credit, but if the MAT is higher, then you'll have to claim more MAT credits. Clear? Yes, this is just a sign for you. This is just a sign. Last year's MAT has got. That is because you have utilized in accounts. In income tax, you're still yet to do it, right? Only when you prepare a computation, you'll know. At the preparation of computation stage, you may realize you may not have to use full 2.15. You may end up using only 1.1. Yes, this is a basic books computation, which has nothing to do with my income tax. You cannot use that as basis. Clear? Yes. Next, you have something called as trade payables. Now, here is where what I normally do is when you have a trade payables, as per the current year's amendment, assessment year 23-24, you need to split them into two. Not MSME. SME, small and medium enterprises, and others. MSC. English people. MSC. Yes, current year's amendment of section 43B comes and clarifies that if you are going to have a transaction within micro and small enterprises, you need to make the payments within the Section 5. MSME. You will have to make the payments within MSME Act regulations. You will have to make the payments within MSME Act regulations. If you do so, then great. Otherwise, you will have a disallowance. So this is one amendment of current year, therefore critical. Current year's tax audit will have this question. You will have to ask this right question. Yes. Next, your employee related payables, people. What will you do with this? Payments relating to gratuity, PF, leave encashment, bonus, and commission, any other tax state payments, will get regulated under section 43B. Which means you'll have to check whether the payments are happening before the due date of return filing. Yes or no? Yes. Second, you will also check this payment for employees PF. You'll also check this payment for employees PF, because please understand, employees PF do not hit your P&L. They are a part of liability schedule. So you'll check it for employees PF for section 3615A. Because whatever money you collected from the employee will also be a part of a liability schedule. Which means here is where you will go and ask whether these payments on 31st March were paid before PF Act due dates. And adhe mari you will check for the prior months also. Manav. 43B. Under what? Or 36. 36 has no disallowance. 36 comes and says bonus to the extent it is appropriation of profit is disallowed. And appropriation of profit can only happen at partnership firm level. It cannot happen at company level. So it is only tackled under 43B. Yes, what you're talking about is partnership level question. That's what. So it says 36 says bonus can be claimed unless and until it's an appropriation of profit. So to the extent of appropriation of profit, it disallows there. Yes, so it is tackled under 43B. Clear? Yes. Next, you have creditor for services. Kind of okay. Kind of okay. Here is where the big issue happens. TDS. Sections 40A, 40A and 43B. TDS is also covered under 43B. Next, penalty and all will come in expense. ESI and all will come under. ESI and EPF will come under 43B, 43B or 3615A, which is done on top. GST, not important because
GST
is never claimed as an expense. GST is never claimed. Correct, Ra. GST is never claimed as an expense. So technically, it is a disclosure in 43B, but does not impact your tax computation. It does not impact your tax computation unless and until it is a block credit. Unless and until it is a block credit, but doesn't matter. Doesn't matter. At the end of the day, it's a block credit. People will pay it off. No one is going to keep it back. Yes. So therefore, GST extent, my feeling, never is important. It's only a disclosure in 43B. When you read 43B itself, 43B will come and say when the tax audit is prepared, when you write the expense itself, they'll come and ask you whether it is passed through P&L or not passed through P&L. GST will always be informed as not passed through P&L, and therefore it is never disallowed. It is never disallowed. Clear? Next, you have short-term provisions. Provision for income tax, relevant, not relevant. It's anyway disallowed in the P&L statement itself, so therefore not important. Next, this is your plant, property and equipment schedule. What is important from here, Rahul? You'll take the additions from here. You'll take the additions from here, and this addition should match your. This will obviously match your cash flow, but it should match your depreciation schedule. It should match your depreciation schedule except for two items. Except for two items. One is called as section 43A. Except for section 43A, where you have purchased assets from outside India. Where you have purchased assets from outside India, the interest against those, the forex loss against those assets will have to be capitalized. Will have to be capitalized. Second, borrowing cost. Second is borrowing cost. These are the two items which you have to keep in mind in your depreciation schedule. These are the only two reasons why your additions will not match your depreciation schedule. Additions will not match your depreciation schedule. Option number 3 should not happen but may happen. Should not happen but may happen, where an assessing officer may propose that an expense of repairs and all which you claimed in P&L could be a capital item. Could be a capital item. Generally will not happen because accounts also has the same logic. So what you do in accounts is what you'll do in income tax also. So technically there should be no difference, but yeah, good to know. Next, you have something called as deletions here. You will ignore the whole deletions. You will ignore the whole deletions. Do not touch the deletions. Do not touch the deletions because you need the. But I prefer to look at the deletions also. I prefer to look at the deletions also only to identify whether there is any slump sale. Only to identify whether there is any slump sale, because the moment you are doing a slump sale, you're technically going to sell assets. And if you're going to sell assets, the first thing which I will always try to encourage is to look how many assets I've sold. And then I will go and ask a question. Tell me why did you sell the assets and whom did you sell the assets? If they come and tell me that Rahul, I've sold some 5,000 assets to one single person, then I will try to understand why did you do that? Did you also give him liabilities? Did you also give him some other transactions? If yes, then I will start computation of slump sale. I'll start computation of slump sale, because please understand people, when it's a slump sale transaction, in depreciation schedule, what gets reduced is not sale value. In slump sale transaction, what gets reduced is a WDV. Yes. So technically in a depreciation schedule, you can reduce two components. Either you will reduce sale value when it is itemized sale, or you will reduce WDV itself if it is a slump sale. You will reduce WDV itself is a slump sale. Bear that in mind. Something which people tend to miss out. But it's a good check to always make. It's a good check to always make, because you never know. It may take a flash of a second for assessing officer to come and say the transaction looks like a slump sale, pay capital gains. Pay capital gains. So be extremely cautious about those kind of things. Yes? Clear? Yes? Next.
The additions made.
That is obvious. That will automatically come. It's not coming from this financials. You're looking for it separately. Yes? It's an unsaid rule, people. You have to look at the same rates of depreciation, and you can also have additional depreciation in case it's a manufacturing entity. Those things, yeah, untold things. I don't think tax audit team will make mistakes there and all. So I don't have to press you on that. In the past and all, I would also use this for something called as investment allowances, 32 AC and 32 AD, but now it is not important. Now it is not important. If you're looking at past years data and all, you look for 32 AC and 32 AD also. While since you have anyway raised this point, I will also probably look for something called as 35 AD assets and scientific research assets. Very good. I will look for these two things also. Yes, because that is all expenses or assets which are to be fully claimed as deductions. Fully claimed as deductions. Yes or no? Yes. This is also another thing which I may look for. Next, you have non-current investments. Notice the investments, Rahul. I've made investments in. Subsidiaries. I made investments in subsidiaries. These are all investments in other companies, which means I am the holding company. I am the holding company, which means I can receive dividends. So I will be taxable for dividends. And therefore will also be eligible for ATM. Whatever dividends I receive, if I issue further dividends, then I can set off. Will come from there. Yes or no? Yes. The moment you put ATM, you will now have to go to something called as reserve and surplus, and you will have to check in reserve and surplus whether you have issued any dividends in order to get your ATMs. Yes or no? Yes. At the same time, if you end up making an investment in mutual funds, that is okay. That is anyway going to come. If you're investing in mutual funds, any issues? Why exempt? Mutual fund is not exempt. So what? Classification is it? Again, you are doing classifications for capital gains. I'm not bothered about. See, those things are not something you'll miss out. Sorry? Maybe. Anything else? No? There is this concept called as bonus stripping. There is something called dividend stripping in the past. Now there is something called as bonus stripping. Provisions basically come and say that if you have purchased bonds or mutual funds 3 months before, and then within 9 months you have sold off the bonds in a loss, whatever dividends, interest, and whatever bonus bonds you got, that will be the loss from the bonds will be ignored and will be added to the cost of acquisition of the bonus bonds. Small thing. You will have to keep in mind that you do not get any bonus mutual funds. There are things to remember, people. Yes. Small things can make a huge impact. Keep in mind. Next, loans and advances. You have something called as security deposit and other deposit. Relevant, not relevant? This would be more relevant from India's perspective. Because you'll account for something called as notional incomes. Not so much important from AS perspective. I will ignore it off. Next, rental and other advances. We'll do it in expense. Next, you have something called as other advances. Not important. You have TDS under GST law. What the hell is TDS under GST law? Why is it an advance? This is not payment. He's telling someone has deducted TDS on him. Wrong disclosures of accounting, people. Accounting standards require that when you have a provision for tax and you have a TDS, you are supposed to offset each other and show them together. This is not supposed to be done. But it is done, so might as well, yeah. Sorry? The mistake is not done by the company. No, the mistake is done by the, yeah, so ask him. Yes, anyway, not important, but just to keep in mind, these are all your advances. These are all your advances. Next, you have advance to employees, people. Thing to keep in mind. Sorry? For you, what is important? 192. When you give an advance to employee, you will have to account for notional interest. You'll have to account for notional interest, and the notional interest will be liable for TDS. So please bear that in mind. Next, advance to suppliers. Important? Important? Not important. Next, due pending for credit availment. What is this? What to do? Anything that you can keep in mind? No. These are all duty people, government grants. These are all government grants. So therefore, you have to look for ICDS. You'll have to look for ICDS standards on revenue recognition. ICDS standards on government grants. The standards of ICDS come and say that you cannot delay the recognition of the duty beyond receipt. Beyond receipt. So even though the duty is pending, it is okay. It is okay. If the money comes to your hand, even though conditions are not satisfied, you will have to account for the grant. Second thing you'll have to do is check whether the grant is related to a asset or revenue items. Revenue items. So this is an ICDS standards on government grants. Does anyone remember what is the government grant standard for ICDS? 7 is 6, I think. 7, huh? 7. 8 is securities, I think. Then we'll discuss. We will discuss. Next, you have something called as inventories, raw materials, stock, finished goods, WIP, goods in transit. Relevant, not relevant? Relevant, not relevant? Relevant only to the extent of satisfaction of ICDS. Relevant to the extent of satisfaction of ICDS. Now, technically, ICDS comes and says you can follow the same standards of accounting. You can follow the same standards of accounting, but there is this one exception in ICDS which comes and says when the company is not going concern. When the company is not at going concern, the assets or the inventories will not be recognized at cost, but will be recognized at NRV. Will be recognized at NRV, which is not done in accounts. So therefore, to that extent, you will have to account for a differentials. You'll have to account for a differential. So that alone, one small thing you'll have to keep in mind. Next, trade receivables. Trade receivables. Check for bad debts. Very good. Check for provision for bad debts. Check for provision for bad debts. If there is any movement in the provision and bad debts, you will disallow. And if there is any reversal of provision for bad debts, you will claim. You will claim. So you will have to do a whole movement schedule of bad debts in order to find out what is the provision schedule. Next, cash. Important, not important? Important, not important? It is important only to the extent of verification of 40A3. You will open up the bank cash statement, the cash book ledger, and you will try to find out if there is any payment on a single day more than 10,000. Payment to on a single day more than. All transactions will appear here only, no? Where will you check all this? Everything here only, no? You'll open what? You'll take the cash book ledger and you'll check the cash book ledger. If there is any payment more than 10,000, for all those things, you'll have to highlight and ask them, why did you make payment more than 10,000? The moment you do it here, everything else is covered automatically. Clear? Yes. So verification of 48.3 will happen under cash and bank balances. Small thing to keep in mind. Yes. Ideally speaking, this should be done by the tax audit team, but yeah, never happens. Never happens. They get an MRL from you saying, come and prove it to me that you have not done any cash transactions. They don't verify all those things. Volume of data, it seems. Yes. Anyway, then you have something called as input tax credit. Relevant, not relevant? Relevant, not relevant? Not relevant. Relevant only to the extent that if you're not able to claim the input tax credit, then you are eligible for expense. You're eligible for expense. Don't claim it as an expense unless and until it is determined as blocked. It is determined as blocked. Sometimes what happens is in input tax credit, there is a policy, sometimes in companies and all. Let's say, for example, in the past when GST was being introduced, there was something called this Swachh Bharat cess and Krishi Kalyan cess. And there was a big dispute going on whether those can be transited from service tax to GST. Yes, when that big dispute was going on, what most of the companies did is they ended up creating a provision. They ended up creating a provision because they thought it will not come. They thought it will not come because there were decisions pending before Supreme Court. Question is, Rahul, can you claim such provisions? Can you claim such provisions? No, because these are ad hoc provisions. These are ad hoc provisions, and therefore all those provisions will get disallowed. So to that extent alone, just keep that in mind. If you are creating any ad hoc provisions under taxes and all, you cannot claim it as a deduction. You cannot claim it as a deduction. Clear? Yes. Quickly going forward, we are looking at our P&L schedule. We're looking at our P&L schedule. We are looking at revenue. Relevant, not relevant. People, revenue, relevant, not relevant. Why would you see related party from revenue? That is from transfer pricing perspective, tax perspective, computation perspective.
Take what is the VAT, then we check that sales related.
43 for a double A or A? Acha, double A for what? That will be another income. No, why you look revenue? What happened in this financials? I don't know. The reason I look for revenue is because I want to check for the turnover limit to be check for the 25 or 30% ka tax rate, to be checking for the 25 and 30% ka tax rate, and probably to check whether you're liable for tax audit or not tax audit. Tax audit you'll check current year's turnover only. So you're looking at that. Which year are we doing? Which year are we doing? We're doing it for assessment at 24-25. For us, I need the turnover of 21-22. That's what I told you. I wanted to check the latest financials. You gave me the old one. So technically, I can find it here itself. This is the turnover limit. Yes. Second is, this turnover limit also helps you to remind your client that, sir, for the next year advance tax, you have to use what rate. That also is one thing. But generally, I look at revenue for tax rate purpose. For tax rate purposes. Yes. Next, other incomes. Looking at other incomes, interest income taxable under other incomes. Open up the breakup. Get the complete details in order to check whether it is capital or revenue receipt. If you find out it's a capital receipt, then you can make choices. Next, insurance claim receipt. Again, very good. Check for capital gains. If the insurance claim is received against a capital asset, then you will do insurance compensation computation. Section 45(1)(a). Section 45 computation 1A. If not, then it will be taxable. At the same time, also see that if the insurance is received against a block of asset, then in that case, this will be fully reduced and will be reduced from the cost of the asset. Next, you have bad debts recovered. This will be checked for adjustment against provision. If this was a bad debts over and above the provision, then you will take this as a income. Balance will become claimable. That will happen. Open up miscellaneous income for us to understand whether it is capital or revenue. Last item is rental income. People, it will help you decide whether you're going under HP or IFOS. Manufacturing entity cannot have this as a nature of business. So it moves into HP or IFOS. For those who understand, current year's amendment of 25-26 comes and says that if you are going to let out any residential property, even if it is your nature of business, it will be taxable under HP. But if it's a renting out of commercial property, you can make a choice. Now going forward, whenever you have a rental income, you'll have to always keep in mind whether you are the owner of the asset or not the owner of the asset. If you're the owner of the asset, it will go under HP, and if you're not the owner of the asset, it will go under IFRS. The moment you do this itself, you should also ask one more question. What? Tell me what are the corresponding expenses. Because those expenses will be hidden here and you'll not be able to find out. So it is good to ask here itself what are the expenses. Give the list of all the expenses and decide which one has to be disallowed and which one does not have to be disallowed. Correct? Correct. Next, you have something called as cost of materials consumed. Any importance? Any importance? You will look for section 194Q. You will look for section 194Q for your TDS. For your TDS only on the purchases. Only on the purchases. Because if you do not do TDS, you will have a disallowance of 30% or 100. 30%. You will have a disallowance of 30% on the same. Yes. Yes. So look for 194Q. It is a forward curve relating to inventories. So it's okay. 43AA will come into picture. 43AA comes and says if it is relating to revenue items, it is allowable as an expense. There is no problem. Yes. So therefore, I would not have a problem here. You are purchasing raw materials, indigenous imported, closing stock and all is just a disclosure item. So I don't have a problem there. I will ignore everything. Then you have a purchase of stock in trade. Again, you're looking for 194Q. You're looking for 194Q. Then you're moving to changes in inventories. I don't care. These are all disclosures. These are all disclosures. Then you have employee benefit expenses. People, what are you doing? You're looking for 192. Then for what? Acha. You're looking for bonus, commission and all. 43B. Next. Next. One more. Why? Why would you look for ESOP related expenses? How does it matter? It's anyway allowable, right? One thing which people normally miss out to notice. Very good. It's not perquisites, it is tax on non-monetary perquisites. It is tax on non-monetary perquisites because income tax says any tax on non-monetary perquisites is a permanent disallowance. Yes. So one small thing you will find in salaries and wages. Please check. Next you have contribution to PF and all. I don't care because I'm going to look at balance sheet item. I'm going to already look at balance sheet level, so I don't have to worry. Next, staff welfare expenses. Relevant, not relevant? For what? Relevant, not relevant? Not relevant. Probably the only thing which you will do is check for TDS. Staff welfare expenses can have TDS. Like for example, you're doing an event management. Yes. Imagine you're going for a big event and all, you will have to do 194J. Yes. So all those event management and all, you'll have to check for TDS. That is the only thing which you can check in this. Otherwise, technically staff welfare fully allowed as deductions. Next. Bonus is there separately down. So therefore, this is 43B. Next, you have interest expenses. People looking for 43B. Then 194A. Very good. 194A. Then 43A does not apply. 43A is foreign exchange loss.
This is paid to banks. 194A.
Oh, acha, sorry. This 194A is on the bottom. Next. Borrowing cost.
Check whether this is business related interest expense or.
If it is not business related, first of all, as an auditor, how did you approve it?
No, sir, this one is for some purchase of capital, something they have paid interest to banks.
Borrowing cost. That's what I said. Yes. Understand, people, if it is not relating to business, first of all, you should not claim. The only thing which can probably be here is interest on rental income interest. Yes, that cases you will have to disallow and take it to HP, but we already discussed that. Yes, coming interest income, interest expense, others. 194A. Anything else? $40.
If there is any MSME interest, we'll disallowed.
Very good. You'll have an MSME interest disallowance. One more. Quickly. Sorry? No idea. They both are also covered under 94B. So you have to find out if the bank is guaranteed commission by related party, then it becomes liable for 94B. At the same time, interest expense others is not given as anything. So I would make an assumption that probably it can be from related parties also. Yes, check for 94B. Check for. Sorry? 94B comes and says that when you have an interest which you are supposed to pay to an associated enterprise, you cannot claim an expense more than 30% of EBITDA. Transfer pricing. We'll discuss. Yes, 94B, something very critical for you to keep in mind. Next, you have bank charges. Allowed. Interest and charges. I don't know what LC is. LC is? Acha, then it is allowed. Then it is allowed. Otherwise, I will check for something called interest on income tax. I will check for something called as interest on income tax, which will get disallowed. As per accounting standards, they have to be generally put under finance charges, and therefore you'll put it there and you'll disallow it. That's what I said. As per accounting standards, interest on income tax is to be classified under finance charges. They cannot be classified under rates and taxes. They have to be classified under finance charges. So normally you'll find it here only. Yes. What will happen in other expenses will be interest on TDS. They will not be there here. Yes. Interest on income tax like 234 ABC and all will form part of this. Next, depreciation, you will anyway ignore it off. You will fully disallow. Moving to other expenses, people look at it quickly. Tell me what and all is important. Advertisement. 194C. Sorry? Donations, huh? Okay. Maybe. Next, audit fees. 194J. Hey, one thing I missed out here. Sales promotion in the 194R. We need to check for 194R also. Next, bad debts. Recovered bad debts all put together. Check for movement. Next, clearing and forwarding. 194C. Communication expenses. Communication expenses normally means telephone charges. If it's a call center, then it is 194J. If it is call center, then it's 194J. Otherwise, 194C. Next, CSR expenses. Fully disallowed. Section 37. Claim 80G. This company is not opting for concessional regime, which means it's eligible for 80G. Next, discount allowed. Donations 80G. You will also have to ask yourself, Rahul, if it's donation relating to scientific research, in that case you can claim it. If not, then you can disallow and then claim 80G. Electricity, power and fuel. I don't have a problem. Normally it is allowed, but sometimes they come and say you have to do 194Q. Purchase of electricity, 194Q will apply. Yes, general expenses. Open up the breakup, people. This is the one expense which assessing officer loves to check. He will always check for it. Because he wants to know what kind of expenses you are clubbing into general and not trying to disclose on the face. Yes, so always look for these expenses. Check for any personal expenses. Check for any director expenses. Check for any penalties and all. All those things will be forming part of this. So please check for this. Next, goods transport charges. 194C and 40A3. Ayya. 194C da. Goods transport get 194C da. 194I will only come on immobile properties and plant and machinery. It has been clarified under a circular saying that when a transportation is being taken, it is always under C and not under I. 40A3, 35,000 payments. Next, insurance. 194 DA, insurance and insurance commission. Interest penalty on statutory dues. What will you do? You will break it up. Interest will get allowed. Penalty will get disallowed. Yes, please keep this in mind, people. There is one thing which people mostly do in a CF return. It is they'll take the whole number and disallow it. Don't make that mistake. Yes, your client is eligible for your interest. Don't come and say that he is not eligible for it. He is definitely eligible for interest. Next, loading and unloading expenses allowed. Packing material allowed. Postage and telegram allowed. Normally will be done to DTC and all those things. You will generally not deduct TDS. Next, printing and stationery. There is a school of thought. One people come and say it is allowed. Second people come and say check for 194C. Yes, some people come and say that the Xerox printing and all, if you are doing it from a same person over and over again, and if you have a contract, you have to do 194C. Honestly, if you ask me, I don't think so. I don't think so, because there is no contract of work. There is no contract of work. So I never tell it is 194C, but there are some decisions, and therefore people are confused. If you come and ask me, it is not applicable. It is not applicable. Sorry? You're not expecting that much of an expense. Yes, majorly people will check for 194Q only in raw materials, because that's where you pay more. If you're not going to pay more, then it's not so much critical. Next, professional charges, rate difference. I don't know what is rate difference. Looks like foreign exchange loss. I would come and say 43AA. People, one thing which I also wanted to bring to attention is, if you are having professional charges, normally all these royalty expenses, HQ charges which you pay to your parent are also parked here. So it is not just 194J, it is 195 also. You will have to get a breakup. To understand what is happening. Yes, because this is also transfer pricing critical. Then you have rates and taxes. Check for penalties and income tax payments. Check for penalty and income tax payments. This is what is there in the rates and taxes. Next, you have refractories. I think looks like a normal expense, so I'm allowing it. Rent 194I. Repairs and maintenance, maybe 194C, maybe, I'm not sure. Next, security charges, 194C. Stores and consumables, 194Q. Subscription and renewal fees can be 194C or 194J or 195. Testing charges, 194C. This is your subcontracting expenses. Travel and conveyance. I don't think so. I mean, see, it kind of depends. Traveling and conveyance will normally have this Ola charges, Uber charges and all those things. I would tend to ignore it. Yes, because then it comes to 194O and they will deduct TDS, and so therefore I will ignore it. If you're talking about airline tickets and everything also, I don't think you generally deduct TDS, because it all forms part of 194O, and therefore it technically never gets questioned. You will deduct under which section? See, normally I would come and say loading and unloading expenses will be paid to DTDC, or it will be paid to customs agents and all government authorities, therefore TDS will become 0. They don't get liable for TDS, normally speaking. Yes, but if you're having a contract with like Blue Dart or something and you're telling that you take care of everything, then you'll do 194C. Yes, this is what will happen, traveling and conveyance, and then yes, everything else is done. This is what your P&L disallowance will look like. How? I think it doesn't matter right now, Sehul, because whether you put it in technical also, the rate is 2 only. The idea is if you deduct 2, I don't care whether you put it on a C or J. Yes, it is only important if you come and tell me it's a professional charge and therefore you have to do 10. That is what the whole idea about bringing 2 was. The whole idea of bringing 2 was that you put it under C also, you put it under J also. As long as you deduct TDS, I'm going to let it go for you. It's technically 30,000 for both, right? It's 30,000 per payment and one. Yeah, I mean, see, I don't think that's still going to be a critical aspect, right? Because, see, if you have to ask me honestly speaking, as a company guy, even I come and tell you one simple thing. As a company guy, I am not bothered about limits, people. Let's be very honest about it. Yes, there is this one thing, because what happens is the person who deduct TDS is AP team, payables team, and the person who does tax filing is tax team. Now, obviously, AP team is not coming and asking tax team every time for the limits. So what they'll do? Standardly, every rupee is getting deducted. Unless and until they'll give me a call and they'll come and say, Rahul, there is a very poor contractor. I'm going to pay only 500 rupees. Do I do TDS? That is the only case it will happen. Otherwise, normally what will happen, if it's a regular dealing, they will always come and say, always deduct TDS. Even in 194Q and all, they will not look for limits and all. 1 rupee also, they'll deduct TDS. Yes. So it is happening on a standard basis. Therefore, I don't see personally a problem anyway. Yes. Apart from this, people, technically you don't have to worry about the financials. Yes. But the only reason I go through the other documents is to see if there is any extra items like the prior year taxes and all those things. Yes, those things will get identified here. So related party definition will come and help you for all your transfer pricing. Keep the transfer pricing. Both. 48.2 again, like he rightly said, no, you will not look for a disallowance. It is only assessing officer who's going to make the same. So I don't care about it so much. Key financial ratio is not important. The key financial ratios is something which I only use in case you are offshoring entity. Like I said, complete transfer pricing entity. In that case, you will keep that in mind. You will keep that in mind. Apart from that, I think I'm looking for that one item. See, trade receivables order motta movement is given here. Provision order movement will be given here. So CSR order breakup is also given here. They're using it for eradicating hunger, poverty and malnutrition. I would come and look for ATG to check whether it is cash or non-cash. More than 2000 not allowed. More than 2000 not allowed. So that is also one thing which I'll check. No proceedings are pending. Great. Company has not entered into any transaction for stuck off. Great. Company has not been declared willful defaulter. Great. No relationship with defaulters of stuck companies. Great. Compliance with large number of layers. Not there. Entered into scheme of arrangement for any accounting impact. Great. Details of cryptocurrency. Not there. In case it was there, it was 194 S along with 115 BBH for 30% rate. Then you have no funds have been advanced or invested by company into any other persons, including foreign entities, with the understanding, whether recorded or otherwise, that the intermediary shall lend or invest identified the person for the beneficiary. So their case weekly coming and saying 222E will not apply because we're not doing any such transactions. Then the company has not received funds from anyone else, and then they're saying there is no income surrendered or disclosed as income under assessments. So they're giving a disclosure saying I'm not doing any survey payments. I'm not doing any survey payments. Or there was a standard in the back where they came and said for a limited period there was a section which was introduced called as undisclosed taxes to be paid, capital gains law. Yes, where they were giving you an opportunity to voluntarily come forward and disclose your investments, in order to pay taxes at the rate of 30%, in which case I will not levy penalty. Clarification. Last item, additional information given. Weird financials, there is something called tax of previous year, but there is no disclosure against it. Technically there should be disclosure against it because it needs to be understood. It needs to be understood. So this is all what you need to do from a normal taxation perspective. Things which you may miss out and may not be there is to always come and check for last year's TP report. Is to always check for last year's TP report, because you will look for TP study, because no, you are looking for any primary adjustment. You are looking for any primary adjustment in order to come and ask whether you have received the money back. If not, then you will be liable for secondary adjustments. You will be liable for secondary adjustments. Second, you will also come and check for any past assessment orders. You will check for any past assessment orders in order to verify whether any assessment orders have been received in the current year. Have been received in the current year, to sure that there is any disallowance made, and if the company has chosen to go for appeal or not go for appeal. If they have not gone for appeal, then great. You will ask if you have done the same treatment in the current year. In the current year. Third, one thing which you are always supposed to verify, at least in the last 2-3 years, is no, you are supposed to mandatory verify something called as AIS. You are supposed to mandatory verify something called as AIS, because the interest income which is here has to be matched with your AIS. Has to be matched with your AIS. If it is not matching, I'm sorry, you will have to make a differential disallowance. You have to make a differential disallowance. You will have to give that income offerance, because you will get a notice which will come and say that the AIS is showing a higher income. Mandatory do that. Second, also AIS will come and tell you what are the refunds issued in the current year and what are the interest against the same. What are the interest against the same? Normally, companies may miss out to account for the interest, because what they may end up doing is they may account everything in TDS itself. In which case, what is happening? Your receivables has come down, but you have not offered income. And if that is the case, you will have to offer the income separately and then reverse the TDS receivable. Reverse the TDS receivable. That is also one thing to check for. Next item, AIS will also come and tell you about any kinds of dividend received, investment sales, purchases made. Yes, investment sales will help you to determine your capital gains. Purchases made will help for exemptions under section 54. Exemptions under section 54 plus chapter 6A also. Plus chapter 6A also. These are the additional things which you need to check. Last thing I always come and ask my clients is that, does your company have any past amalgamations? Does your company have any past amalgamations? The reason I ask that is because if the company has any past amalgamations, I will then ask if there is any past assessment spending. Past assessment spending or past refund spending. Because if any of the past refunds have come, they will come in the accounts of old company. They'll come in the accounts of old company and will not be appearing in your company. But tomorrow you'll get a notice and they'll come and say, okay, show me where did you offer the tax. And if you don't offer the tax, they will end up penalties. They will end up with penalties. So that is also something additionally which I check for. Yes, Again, all those things will only be identified when you know the nature of business. When you know the nature of business, get all this download, people, before you start doing a computation. Then only you can do a justified computation. Otherwise, these things will keep happening. These things will keep happening. Clear? Hello? Yes? Great. This is how I review a financial statements, regardless of whether it's a service industry or a purchasing industry. I do not come and ask whether it is there in the financials and then look for a disallowance. I first figure out what are the disallowances possible and then check whether it is applicable or not applicable. It opens up a new gambit for you to understand things differently. Yes, and that's when you can start asking the right questions. Yes, so this is one of the approach which I do for my financial statements. If you think it is useful, follow this for your statements also, and try to prepare a computation this year. Compare it with your boss. See what he prepares versus what you prepare and see what differences you both arrived at. Yes, that will be a good starting point for you to come and understand that yes, you are doing a good job or you are still lacking on some things. Yes, anyway, as we have written the section numbers right now, we will be discussing all the specific sections and you'll understand those sections in detail right now. But now you'll be able to link on what we spoke about so that you can appreciate it a little better. Yes or no? Yes? Great. Let's do one thing. Let's cut for breakfast. We will come back at half an hour is okay for everyone? You want a little bit more? Let's do 10:45. Let's do 10:45. Yes? All right. Let's start with something technicals about income tax, right? We have done with what the basics are. We are going to now start into the specifics of income tax. Yes. We're moving on to our golden rules once again. Where we have completed step number 9 and step number 10. We're now starting from the top. We started with step number 1, which is identifying question, which is what you're doing. Yes. The step number 2 was identify the person and his resident status. You have identified the person already. You're now trying to identify the status. Status will normally happen in residential status. Now, luckily, resident status is not so important from exam perspective because it is moved to inter. And therefore, you will learn it in non-resident taxation along with me. I will not spend too much time, but it is still there. We'll focus upon it there. Yes. That brings you to step number 3, which is determining whether the income is taxable or not. Again, you have to do it in a part of exemptions and everything. We'll do it as we discuss the chapters. We are now starting with the step number 4 and the most critical step for your exam purposes, which is called as classifying your income into 5 heads and then providing respective deductions and exemptions. Yes, one of the most important topics from your exam perspective, because let's be honest, if you're going to have a 100 marks paper, the first compulsory question is going to be a total income question. Yes, and therefore you should first try to understand how to do your incomes. Yes or no? Yes. So what we're going to do is we're going to start with Pgbp as we speak. But before I do that itself, let me also do one thing. I will also tell you that people, salaries and HP is not a part of syllabus. But at the same time, some part of salaries and HP is still being tested in double taxation. Yes. So luckily what has happened is we have a page here, page number 33. What we're going to do is I'm going to give you some small notes, which is okay to keep in mind from salaries and HP perspective so that you can keep that in note and then you can use it for your double taxation and then we will take it from there to go to Pgbp. Yes. Yes. Great. On this page, people, the heading is called as heads of income. On this page, we are going to put a head of heads of income. What are the first heads, people, which is not a part of syllabus, which is salaries. We are going to keep salaries. Yes. Now, I don't have to tell you what salaries is. There is basically an employer-employee relationship, payment happening in those relationship and all those things. Yes. From an exam perspective, what is important is to know how to compute income from salaries on a top level. So the first thing which you need to keep in mind is if in exam they start using the word salary received during the year. They use the word salary received during the year. People, what do you understand from this? This is the money which you received in your hand. Which means this is the money before standard deduction and other exemptions. Yes. Now, as a part of your syllabus, you will not be tested on any deductions and exemptions except for the last ones, which is section number 16. So what you are going to say is, Rahul, if it is called a salary received during the year, this is before any deductions. This is before any deductions. Yes. Now, from an exam perspective, what deductions do you have to keep in mind is, Rahul? That is deductions under section 16. Deductions under section 16. What are the deductions, people? First thing you have is called as standard deduction of rupees 50,000. Standard deduction of rupees 50,000. Now this is what the standard deduction is. This is what the standard deduction is. But current year's amendment of section 115 BSc. Current year's amendment of section 115 BSc. For the first time in life, new regime is giving you extra benefits. New regime is giving you extra benefits. Normally, what is the point of new regime? They will come and say, I'll give you a lower tax rate in exchange for higher income. But this is the first time where Nirmala ma'am has come and decided that the new regime itself will give you more benefits than what is normally happening. And so Nirmala ma'am has come and confirmed that if you are going to be under old regime, you will get a standard deduction of 50,000. Whereas if you are under new regime, you will get a deduction of 75,000. New deduction of 75,000. If you ask my personal opinion, in your exams, if at all a question has to be asked, they'll ask you a double taxation question specifically to the default tax regime. They'll ask you a double taxation question specific to default tax regime, where they'll come and say the salary received by a person is 10,000 per month. You will do what? Take 10,000 into 12, 1,20,000 minus 75,000. Yes, this is what my impression is on the exams this year. This is what you're expecting, either in May 25 or in November 25. One of these two exams, definitely this is the question which is coming for double taxations. Clear? Yes. Brings you to point number 2. What is other deductions, people? You have professional tax paid by both. It is professional tax paid by both. Any PT kind of payments happening, either it is done by the employer on behalf of employee or directly by the employee. Whatever numbers are paid will be fully allowed as deduction only under old regime. Only under old regime. Understand? New regime comes and says section 16 only standard deduction is granted, any other deductions are denied to you. So I don't have to worry about it. Yes. So the two things which you need to keep in mind from salaries perspective is, if a salary is received, then you have to grant for deductions. Two deductions to keep in mind. One is standard deduction of 50,000 for old regime, 75,000 for new regime, and professional tax for old regime. This is all that you need from salaries perspective. Nothing else is important. Good to go. Yes. Now the same thing you learn in the default tax regime chapter. When you go back to the special tax regime, you will find the same points here. If you notice here, the points come and say, if you notice the points here, I have told you what are the deductions which are not permitted, and I already told you this is not important from exam, so you can ignore all those. The only thing which is important is section number 16, where they're coming and clarifying the following deductions are not eligible: entertainment allowance, professional tax, and I put a line here which comes and says standard deduction is claimable and is increased to 75,000 under default regime, where it was earlier 50,000. If you don't find it here, you can find it here, where it comes and says increased deduction is for standard deduction, you will get an increased deduction of 75,000, where the old regime gives you 50,000. Yes, please mark this is important. This is mandatory from exam perspective. Can we go forward? Yes, great. We are then moving on to the next chapter, which is called as income from house property. Before I do that, let me also put down a note and come and clarify. If the wordings used are if the wordings used for salary, income of the year, or income from salaries, within bracket computed, what do you mean now? This is the final number. No action to be taken. This is the final number, no action to be taken. Yes or no? Yes. Now, honestly, if you ask me, if I'm an examiner and if I have to complicate life a little bit for you, if I have to complicate life for you, I can also play one more thing. I can come and give you a question where I can come and say, salary computed as per alternate regime is so and so number. Salary computed as per alternate regime is so and so number. Compute salary under default regime. What will happen? You will then make an assumption that under old regime you claimed 50, therefore in default you will have to claim an additional 25. Yes, these are all combinations also which can happen. Yes, so please be mindful about those combinations because it has come in the past. Where what will normally happen is they'll give you a question fully under old regime, and they'll give you MCQs. Suddenly last MCQ will come and say, what would be the tax if the person is opting for default regime? In that case, what you'll have to do, you'll have to remain the number as it is, but grant the additional benefits and then compute tax and then come and say which one is beneficial. Yes, so any combination can work, so work with that. Yes, there is a way where I'm coming and saying nothing is done, therefore you will give either 50 or 75. There is a way where I can come and give you one with minus 50, in which case you have to give minus 25. And there is a one where I can give you salaries minus 75 and then I'll ask you to add back 25. Any of the combinations can work for you, so please be mindful about any of the combinations. Clear to go? Yes, can we move forward? Yes, brings you to the next part of it, which is called as house property. Yes, now the same logic works in house property, people. I am coming and saying what is the format in house property? It is gross annual value minus municipal taxes paid by the owner. It is GAV minus municipal taxes paid by the owner. You will arrive at NAV. On this you will allow? No. You will add arrears of rent. Or unrealized rent. You will add arrears of rent or unrealized rent. You will arrive at total NAV. In this you will reduce 30% of total NAV, and then you will reduce interest on loan of 2 lakhs or 30,000 if SOP, or actual if LOP. The moment you say DLOP, it's equal to LOP only. Yes, people. Yes. This is what your format for HP is. Now, in exam perspective, there are other things like part SOP, part LOP, pre-construction interest. All those things are not being tested. Yes, what is going to be tested is they'll simply come and say there is a person who's received rent of 10,000 per month. Tell me what is the income from house property. You'll just take 10,000 into 12 minus. If you have municipal taxes, you claim municipal taxes. If not, you will directly minus 30%. Option number 2, there are some questions in exam where they have come and said what? There is a person who's received rent of past years in the current year. Where the person was not the owner in the current year. So they basically come and give you a question where they'll come and say there is a person who's received rent of 10,000 in the current year pertaining to FY 16-17. The house is already sold 2 years ago. The house is already sold 2 years ago. You're talking about arrears of rent. You're talking about arrears of rent. The only thing you'll do is you'll take the arrears and that's all. You'll take the arrears, you'll deduct 30%, and this is what the number will be. This is what the number will be. So please bear in mind, either it can be current year rent or it can be past year's rent. It doesn't matter. No matter what rent it is, you just have to reduce 30% ka standard deduction. You just have to reduce 30% ka standard deduction. Clear? Clear? Also bear in mind that if you are under default regime, interest on loan of 2 lakhs or 30,000 is not allowed. Interest on loan of 2 lakhs or 30,000 is not allowed. Meaning, if you are under default regime, you can only claim actual LOP interest, which means if you are under default regime, the income from house property will be zero. Because SOP, the only deduction you can claim is interest on loan, and that is also denied for you. So under default regime, interest on loan is zero. Therefore, loss is also zero. Default regime will apply as it is. Alternate regime will apply as it is. Clear? Yes. So if I have to split this into two, I'll come and say, tell me whether you are in default regime or you are in alternate regime. If you are under default regime, what we did is our answer. If you are under alternate regime, I will come and ask you whether it's SOP property or LOP property. If it is SOP property, I will say it is fully zero. And if it is
default regime, you will say
SOP is zero. Under default regime, I will ask you whether it's SOP or LOP. If you say it is SOP, I will say the answer is zero. Ignore the whole sum. But if you say me it is LOP, I will follow the format. Are you clear? Yes, please bear these things alone in mind. If you know this much, enough for your exam. Other than this, I don't want anything else in the head of income. It is not there in the syllabus also. In the syllabus, in the rates of taxes alone, one small box is created. And in that box, this much they have given. And they're using this alone for your double taxation reliefs. This alone, if you remember, that is enough for me. Clear enough? Yes? Can we go forward? Sweet. We are now going to start with our most important chapter from exam perspective, your profits and gains of business or profession. Yes? Great. Now, before I start itself, let's look at the heading once again very carefully, people. We are looking at profits and gains, business or profession. I think we already discussed it, but I'm clarifying it once again. There is an and, there is an or, and the placement of both are important. You cannot say profits or gains, business and profession. It doesn't work that way. They are coming and saying either you pick a business or you pick a profession. If you pick a business, any profits and gains are taxable. If you pick a profession, any profits and gains are taxable. That is what the impression is. Yes or no? Yes. On a high level, Rahul, what do you mean by business and what do you mean by profession? Business is a venture to earn profits. Profession is? So if you affiliate yourself to a certified body only is when you can do profession. Basically. Okay. Question is that you are deciding to become a dancer. Mandatory to get certifications. Income is still professional. Trade, manufacture panna.
some skills. There should be some vocational skills.
Okay, what is business? Venture to? Is professional not having a venture to earn profits? Then how do you differentiate between a business and profession then?
There is no application of skills there. Profession, we need some skills. If we trained or something like that.
So if an Apple industry decides to open an R&D function,
One of their functions, but it's not that.
they're still doing application of mind. And last I checked, Apple is only into R&D. They don't do anything else only. They're technically a middleman for only R&D services. I don't think you can say Apple is a professional entity. Chapter heading hai teri la. What is the difference between business and profession, people? You and I are?
Professionals.
Sure, huh? You are professionals. I, in my office times, is professional. During teaching times is? Okay, teaching is professional or business? Teaching is?
Teaching is a profession. So you mean to say other than individuals, no one can drive?
Hey, teaching is professional or business?
Profession is profession.
Teaching is a business. Teaching is a business. Section 44AA defines what is notified professionals and does not include teaching inside it. Teaching is a business. Yes, ask me, I'll know. Whatever income I'm generating out of you, I'm paying 6% tax on it. Because? Obviously. Why would I pay 50% on that? Hello? Yes or no? I'm paying 6% on it because there is no notified professional for me. I'm not a professional when it comes to my teaching part of the business. So which means I make only 6% profit out of it. Yeah, technically. Yes, understand people. From a practical perspective, how do you define what is a business or a profession? I would come and say it's difficult to define what is profession. Yes, it's rather easier to define what is a business, and income tax has defined business for you. They come and say business includes any adventure in the nature of trade, commerce, manufacture. Any adventure in the nature of trade, commerce and manufacture. What do you mean by adventure, Rahul? It's basically where you're going to uncertainty. It's where you're going into an uncertainty. You don't go there with an intention very clear that you will only make profits. Yes, you're playing around. You're playing around. If it comes to you, great. If it doesn't come to you, it doesn't come to you. Yes, that is what is an adventure. Right? So you're going with an adventure of anything relating to trade, meaning buying and selling. Anything relating to commerce, meaning service sector. Anything relating to manufacture, meaning making a new thing. If you do any of the adventures, then it is called a business. And if you do any incidental activities relating to this also, it is called as business. It is called as business, which is why Apple is technically considered as a business guy, because they are into the adventure of commerce. They're into the adventure of commerce, where they are doing R&D for the mobile phones. They're doing R&D for the mobile phones, and incidental to that, they're also selling mobile phones. Incidental to that, they're also selling mobile phones, and therefore they get classified as business. They get classified as business. The issue comes up with professionals. Income tax did not define profession itself. Income tax came and said professional includes vocation. Profession includes vocation. So they don't know what is a profession, but they clarified that vocation is profession. They clarified vocation is profession, and therefore what happened is at a later stage they brought in a section called 44AA, where they spoke about books of accounts. And in that books of accounts they defined that if you are a notified professional, you have certain stringent conditions. What are the professionals, people? Accountants,
Engineer,
architect, engineers, doctors, information technology, any kind of film related activities. All these items are covered. Lawyers, advocates also are covered. Very limited scope. Very limited scope. Those are only the people who income tax deems as professionals, apart from vocation people. Apart from vocation, any kind of extracurricular activities, the things which your parents say should not be doing in life. Yes, all the things which your parent come and say this is all okay, but get a degree for yourself. Those are things called as professionals, because you're earning money out of it. So if you can bring money for your parents, then it is profession. If you don't bring money, then it is hobby. That is what the logic is. Clear, not clear? Yes. Now here is where it comes in, Rahul. I come and say, Rahul, business means any kind of adventure. Profession means any kind of vocational skills. Here is where income tax then brought in the charging section of Pgbp, section number 28. Where income tax came and told.
income tax means to say that only individuals can carry out profession.
Technically yes, but answer is no. Technically yes, answer is no. I'll tell you this. If I have to answer this for you, there is something called event management. Right? Now there is this ICI rule where ICI comes and says if an event management is happening by an individual or a group of a firm, then it is taxable under 194J, because then it is professional service. But if the same event management is happening by a company cannot technically being a professional, they will do 194C. Now this is what ICI says, right? But this is not what income tax agrees to, in the sense that, let's say for example, my company is a HR staffing company, and my job is to give you doctors. When my company is giving you doctors, technically my job is to do subcontracting of doctors. Subcontracting of doctors. Now, if you come and tell me that Rahul, my job is to give you doctors, you will come and say I'm a professional. But at the end of the day, I'm a company. I'm a company, and therefore I cannot be called a professional. Correct, not correct? In which case, I would come and say I should not be taxable as fees for professional service. I should be taxable as fees for technical service. Yes or no? But that is not what is happening. That is not what is happening. Income tax department has made it very clear that even if you are a company, you are technically providing professional service and therefore will be taxable for 10%. Right? If you ask me, I would prefer ICA opinion. I would prefer ICA opinion where I would come and say professionals are technically only those people who are individuals. Yes, you cannot come and say a company can be a professional. That makes no sense. That makes no sense. Yes or no? Because it's like coming and saying when I am a company, I will obviously recruit CAs, non-CAs, advocates, non-advocates, group of professionals, group of non-professionals also. At which point of time do I decide who is overpowering? Yes or no? My same company is also providing services to my group companies as a accounting support service. You know how offshoring services work, right? GCC entities. Yes, your same company will be providing accounting services for another company outside India. When you qualify CA and you sit for placements, the one big company which will come and sit is GDS, Global Delivery Centers, where they'll come and say you are an Indian CA, but you should be doing foreign laws. So you'll be sitting in an Indian company doing accounts for US companies. Now think about it and tell me, technically, you are providing accounting services, which means you are a professional, but the company is not providing accounting services. The company is also into other activities. In that case, can you come and say, Rahul, one of the nature is professional and the other is not professional? Doesn't make sense. Yes or no? Yes. So there is a very subtle difference and there are very disputed matters. There are various disputed matters. There is no clear clarity on it. If you come and ask me as a line of defense when I go to officer, I would come and say that a company should not be providing professional service. Deloitte is a CA firm.
Let's say some hospital. We'll say for tax purposes, we'll say that
hospitals are again trusts.
So the limit now we should see for professional. CA is a professional. Deloitte is a CA, professional CA.
But it's a firm. The problem only comes with companies. An individual and a group of people in firms are still called a professional. But when it comes to companies is where the whole challenge is. We don't know what the right answer is. Right? If you honestly ask me, no company should be paying TDS at the rate of 10%. My personal opinion. But people are doing it. Yes, so therefore there is no right answer to it. It's a disputed matter. You can always go and fight. Honestly, in my company, I'm always fighting. Yes, I've gone and informed all my clients that I only want TDS to be done at 2% rate. I do not want any TDS at 10% rate, no matter what I provide. Yes, some clients agree to it, some clients don't agree to it because at the end of the day, it's their issue. Tomorrow, if they do a 2% and then assessing officer asks them to do 10%, they will have a demand and penalty. So some clients agree to my position, some clients don't agree to my position. It's a line of defense. You can try what you wish for. Yes. The reason why we brought this into picture is because of treaty. There is an article in treaty for those who are aware about it. An article of treaty called as income from professional services. And the income from professional services treaty article comes and says any income derived by a individual or a group of individuals in a firm, which means treaty on a global level itself has confirmed saying that professional services can only be provided by individuals or firms. Yes, and therefore on a global level it is agreed by treaties that companies cannot provide professional services, and therefore that is a position which can be taken. There is a way of line of defense, but it is still very disputable area. Yes, at the end of the day it is not worth it because it's tedious. Whether you do 2% or you do 10%, at the end of the day it will come back to you as refund. The only thing which will happen is we'll have a cash flow blockage, right? So is it really worth taking the risk is a choice you have to make. It depends on the nature of company and it depends on the risk appetite your management has. Otherwise, I would still come and say it should be liable at 2% and not at 10%. Clear? Yes? Great. Let's go from there, people. I am coming and saying we are doing Pgbp chapter. Under Pgbp chapter, we are looking at the charging section called section number 28. Section number 28, where this section basically comes and says what is taxable under Pgbp? Pgbp. What is taxable under Pgbp? Pgbp. Yes or no? So the section starts with coming and saying the following incomes are taxable under Pgbp. What? Profits and gains of business or profession. What is a company? Company. So what is Pgbp? Pgbp. Yes, which means it is open for interpretation right now. It is open for interpretation right now where you can decide what is taxable under business and what is not taxable under business. Various interpretations to go with. Yes, what we're going to do is we're going to read the section once. The section line number 1 comes and says what is taxable as PGBP is PGBP, but then after that starts deeming fictions. After that starts deeming fictions, which means income tax has now come and clarified what are the additional items which they would like to tax under PGBP. Yes, let's read the lines together one by one and we'll try to understand if we make sense of it. Yes, section number 28 comes and says the following items are taxable under PGBP: any kind of profits and gains of any business or profession which is carried out during the previous year. So what is taxable under PGBP? Straightforward PGBP, no doubts about it. Yes, now here is where then the question comes. Rahul, how do you decide whether it's a PGBP income or not a PGBP income? How do you decide whether it's a PGBP income or not a PGBP income? You also put sale of shares in profit and loss account. Does it become PGBP then?
Somehow related to my business.
Somehow.
The income should arise from my business.
Interest on FD? But you put it out of your business money. Ordinary? I keep investing in FDs daily basis then. Doesn't have to be. You said incidental to the business.
Should arise from my business.
Should.
Income should arise from my business.
So if you sell assets,
Selling assets is not.
but it's arising from your business, no? Now you are not clear or I am not clear. Either you are not clear or I am not clear. You said profits and gains derived from any business or profession. How do you decide whether something is profits or gains derived from business or profession? No? Shall I give you a question? I'll give you one question. Tell me whether it's PGBP or not a PGBP. Here is a case where what happened is I was working in a company. Now the company is called A Limited. This company had to enter into a contract. So it went to a supplier and came and said, I want to enter into a contract with you. Where you will supply me, let's say 100 crores worth of assets. Supplier came and said, sir, I'm ready to do the work for you. But you're talking about a big order. 100 crores you're talking about, not a small number. I need some confidence that you will pay the money. So I requested him to do one thing, sir. You don't pay me this 100 crores until I complete the contract. But you put it in a special account. You park it in a special account where escrow account. You park it in a special escrow account so that you cannot derive the money if I complete my contract. After the contract is completed, I will take the money out of it. Yes or no? So what I did is I told, okay, fine. I will put it in a escrow account so that you can satisfy your guarantee. Now, obviously, if you're going to put it in escrow account is going to get you interest. Question: the interest which came from the escrow account, which was created specifically for the purpose of my dealing, without which I could not enter into this transaction, will be taxable under the head. You got my question? I created a special escrow account only because of this dealing. If I don't create the escrow account, this dealing will not happen. And in that dealing, I got an interest income. This interest income will be taxable under the head. Because it does not. But if you don't do this, it may become taxable, right? Correct.
Putting in escrow account is only mandated under the contract. I think interest is.
But you also know the fact that the moment you put it in escrow account, you are going to get interest. Aren't you aware? It's not incidental. The putting in escrow is mandatory. See, you may get it as incidental, but at the end of the day, you have to get that money. No, it's not like you don't know about it. Do you know about it or don't know about it? Is intention important? Okay, I'll ask you a question. Imagine a decision where what is happening is you're deciding to enter into a contract with me. Yes, and as a part of the contract, it's come and said that you have to deliver all my raw materials in 2 days. If you don't deliver the raw material in 2 days, you will have to pay penalty to me. Is your intention to collect penalty? Is your intention to collect penalty? No. Tomorrow, if you don't deliver, what will happen? It will be taxable under. Why?
It's a deviation. This is a deviation.
Where is it given? Enna kuduthirukken?
Any compensation in received.
That is for termination and modification of contract. There is no termination, no modification. This is a part of the contract. Where is the termination or modification in this? What is given in 37? 37 is an expense section. It's not an income section. I am receiving compensation. You're going through the definition of business, okay? Huh? 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 It includes any trade. Huh? So then if you talk to me on that sense, and everything else is interest on FD is also business only then. People, this is taxable under Pgbp. This is taxable under Pgbp. Delhi High Court decision in the case of K and Co. Delhi High Court decision in the case of K and Co came and clarified that when you are mandated to put your money into some account only for a specific reason of a business dealing, any derived income out of it is purely incidental and relating to business, purely incidental and wholly and exclusively related to business, and therefore will be taxable under the head Pgbp. Will be taxable under the head Pgbp. Please understand, people, there are two things. One is where you are getting this money because you decided to do it, and one is where you're getting this money because it is asked to be done. It is asked to be done. When you put the money in FD, you made the decision to not to do something which is a part of business, to not do something which is a part of business, and therefore it became taxable under IFRS. When you received interest here, you never made the decision. You only decided to put the money in a FD because it was mandated to be done. Because it was mandated to be done, which means this profit came from the business dealing. This profit came from the business dealing, and therefore will become taxable under Pgbp. Here is where you have to read the line once again carefully. Line says profits and gains derived from any business or profession. Is it my business to put the money in that security escrow? Is it the profit derived from that? It becomes taxable under Pgbp. It becomes taxable under Pgbp. Yes or no? Yes or no? Yes or no? Yes. Here is where the question is. Rahul, ask yourself a question. Is the dealing important or mandatory for the business or not? If you say yes, it becomes Pgbp. If you say no, it becomes IFRS. If you say no, it becomes IFRS. I'll give you another example. Imagine you're a company. Imagine you're a company deciding to get share capital. Today you got share application money, and Companies Act mandates to you that it has to be put in a special account. Now, because of Companies Act mandate, you're putting this in a special account and deriving interest out of it. Yes or no? Yes or no? Yes or no? Rahul, taxable under. Sure. Taxable under? Not taxable itself. Was it your business to collect share application money? This was a capital transaction. This was a capital transaction. You will incur expenses against IPO and you derived incidental income against IPO. What will you do? You will adjust my income against my expense, and you know the expense is capital expense, which means if you're adjusting income, it becomes capital receipt. Correct? No. Which means it becomes non-taxable. It becomes not. Hey, hello. You understand what I said? You understand what I said? Understand, people, here it was not a business dealing. You put this money into the bank account because this is your share capital increase. This is your fund flow, which means the income is derived from the fund flow. It is not derived from business. And therefore, whatever income you get from the fund flow, you will correspondingly adjust against it. You will correspondingly adjust against it. Correct? Not correct? Correct? Not correct? There are some similar examples like this. Imagine if you are having a asset and you're planning to do a trial run. You will incur trial run expenses. But at the same time, whatever goods you make, you will sell the goods. The goods which you sell are a part of post-production or during trial? During trial. Can you put it in P&L? You will come and say what? Reduce from cost. Why? Because it is directly derived from the cost. It is directly derived. Same logic, no? I have IPO expenses. Interest is directly derived from the IPO expenses. Therefore, I will knock it off, which means it becomes capital receipt. It becomes. Correct? No. Correct? No. I am putting this escrow account because of my business dealing. So whatever money comes from this is also taxable under Pgbp. Correct? Not correct? You understand what I said? Yes or no? Yes. You never read this line like inter. Yes. Now you understand things differently. Understand, when you do a business dealing, any transaction coming from the business dealing becomes taxable under Pgbp. Becomes taxable under Pgbp. Correct? No. Correct? No. Are you clear? Can we go forward? Can we go forward? Yes. Point number 2. What does point number 2 say? First one says any kinds of profits engaged derived from any business or profession during the previous year. Point number 2 says compensation or other payment, whether revenue or capital, due or received in or connection with the termination and modifications of the contract. Now, when we discuss the basics of income tax, I came and clarified one thing to you, that every time you derive an income, you need to ask yourself whether it is capital or revenue. If it is revenue, it is taxable, but if it is capital, then you have to define it under 224. Therefore, what happened? This provision got inserted in 224, where they came and said that if you are going to do a business dealing, and the business dealing is getting modifications, whatever compensation you get against it will also be taxable under Pgbp. Like the example I gave you, agency, where you have multiple agencies and one of the agency goes forward, you will say it as revenue receipt. Second, I came and told you that you are only an exclusive supplier of Samsung or exclusive supplier of Airtel. Whatever compensation you get will be the capital receipt. But at the end of the day, both are for business. And therefore, they gave a clarification saying whether it is capital or revenue, I don't care, it is taxable under Pgbp. It is taxable under Pgbp. Correct? Not correct? Correct? No. Point number 3. Read. It says income derived by a trade, professional or similar association from specific services performed for its members. What is this? ICA. This is what we discussed in the first half of the class today. We spoke about cooperative society. Where I came and told you cooperative society will generally not be taxable for any money derived from itself, but they use the word from specific services. I told you, no, if you enter into any such transaction which is not for the benefit of each other, but is now a commercial decision, all those will fall here. Which means even if you do transaction with your own members, but it is not a commercial dealing. It is not a mutual dealing. It's not a mutual dealing, but a commercial dealing will become taxable here. I'll give you one of the case laws, people. There was a case where what happened is there was a cooperative society. And one of the banks were a part of the cooperative society. What is happening? The bank is a part of the cooperative society. So what the cooperative did is they came and said, whatever money I'm collecting as entrance fee, whatever money I'll collect from the entrance fee, I will put it in the bank. Which bank? The members bank. I'll put it in the members bank for safekeeping. At the same time to generate interest. Whatever money comes back, I will use it for my members. Yes or no? Tomorrow what happened? The bank FD generated interest. And the cooperative society came and said this interest is exempt from tax because it is derived from my own members. It is derived from my own members. The bank is my own member. I put money and I got interest, which I'm going to use for my own members, and therefore it is exempt from tax. Principle of mutuality. Principle of mutuality. Tell me, person is correct, not correct? Why?
Principle of mutuality will not apply in this case.
Why?
I should give something and get back.
Meaning?
Principle of mutuality.
He only gave me entrance fee. I put the same money back in FD, and I got interest out of it. அவனோட கொடுத்த entrance fee திருப்பி FD ல போட்டுருக்கேன். Question: taxable, not taxable? Taxable, not taxable? It is taxable, because understand, principle of mutuality means the money should be revolving with only the internal members. With only the internal members. Understand, the moment you took this money and put it in the bank FD, what did the bank do with the money? It will lend it to further people. It will lend it to further people. Now there are third parties getting involved. There are third parties getting involved, meaning the money is now not between us. The money is now gone to third parties also. At the same time, when the bank used this money, the bank used it for commercial operations. Bank did not use this money for our internal benefits. Yes or no? Now this was a transaction done with members only, but still it is commercial in nature, and therefore it becomes correct, not correct? Income derived by trade from specific members. Income derived by trade from specific members. Clear, not clear? Yes. People, I'm just giving you examples for you to understand these things better. If you are able to remember the examples, great. If not, make a note. It's okay. Yes, make a note so that you can keep these things in track. Clear enough? Yes. Point number. Profit on sale of import entitlement license. What is this? Sale of? That I read. What is it? You will be given special import entitlement license. Generally, imports are prohibited in India, but some entities are given special licenses where they are okay to permit imports. Okay to permit imports because they are granted special benefits, because they are also further exporting and all those things. Yes, all those entities, when they have a license, they are granted special benefits. Now it's a free license, but obviously tomorrow if this same entity goes to someone else and says, you know what, I have a license, I'll give it to you if you want to import. Will you give it for free? Whatever money comes is profits. Now what happened is, in the past people came and said, Rahul, this is not a business dealing because it's a capital receipt. Because it's a capital receipt. To justify that, they brought in this amendment and they came and said any profits derived from import entitlement license is Pgbp. You want to go somewhere? Clear? Yes, yes, yes. All the things after this is also same. Is also same. Point number 5. What does it say? Cash assistance or drawback received against exports made. Same. Duty drawback, whatever you get is taxable as Pgbp. Next. Profits on transfer of duty entitlement passbook scheme or duty free replenishment scheme. I am now having a special certificate which helps me to import products duty free. Import products duty free. I can give this license to someone else and make profits out of it. That will also become taxable under Pgbp. Next. Any benefits or perquisites arising from business or profession, whether convertible into money or not, in cash or in kind, or partly in cash or partly in kind. Hey, reading the definition itself, somehow you feel like the definition is extended. Yes, this definition has changed over years. This definition has changed over years because people were avoiding taxes significantly because of this. Yes, if you read this line past, the past line used to come and say any benefits or perquisites arising from business or profession, whether convertible into money or not, full stop. Whether convertible into money or not, full stop. That is what the definition was. Meaning they came and said if you get a gift in the business, whatever gift you get will be taxable for you. Will be taxable for you. Here is where came a very, very famous decision of India called as Mahindra and Mahindra. Called as Mahindra and Mahindra Supreme Court decision. Supreme Court decision. Anyone is aware about the facts? You know the facts. No one. Case was like this. There was an entity called Mahindra and Mahindra, which you all are aware about, the famous entity. The famous entity. What this entity did is, entity wanted to buy some assets. Entity wanted to buy some assets. So it went to a company called KJC. It went to an entity called KJC and told them that, dear entity, I want to buy assets. I want to buy assets. Yes or no? KJC came and told, KJC was a foreign company. So KJC came and told, you know what? I will ask my subsidiary sitting in India to give you the assets. I will ask my subsidiary sitting in India to give you the assets. So what happened? The entity called KJCA So KJCA went ahead and gave assets to M&M. Let's assume for the sake of convenience 100 crores worth of assets. What should M&M do? Pay money back. M&M should pay money back. Very beautiful decision done by one of the big fours of India. They came and said, you know what? Tell M&M that they don't have money. M&M has no money, which means M&M will have to borrow. M&M will have to borrow from banks. They said, no, let's do one thing. Ask KJC to give the money. Which means now what is happening? KJCA will supply assets. KJCA will supply assets and KJCA will give loan. KJCA will give loans. Now what is happening? Parent will give money to buy the assets from subsidiary. Parents will give money to buy assets from subsidiary. So now what is happening? M&M will do what? M&M will take loan from KJC and pay back KJCA. Why did this happen, people? Why did this happen? Hey, KJC wanted to pay KJCA. They wanted to repatriate profits. Direct repatriation would have caused problems. So what they did? They brought in another entity. Now what is happening? They will pay M&M. M&M will pay KJCA. Indirectly money went from KJCA to KJCA. Yes or no? Tax-free money. Money traveled from foreign to India, no problem anywhere. Now you will come and ask me, Rahul, okay, but M&M has to pay back the money, right? Which means technically what KJC will again get back the money. Later on what happened? They came and said, you know what? This entity was taken over by another company called AMC. And AMC apparently decided that they don't want this money back. AMC decided they don't want the money back. So they went to M&M and came and said, you know what? I am the new parent. I am not interested to have the money back from you. Therefore, waive it off. Waive it off now. M&M is not liable to pay any money. KJC will not bring money. KJCA got the money it wanted. Yes or no? Now here is where what happened. KJC and AMC were outside India. So India ka problem illa. M&M was supposed to receive assets. And it got assets for free now. But it never said it got it for free because it said I had to pay money. And therefore assets came at full value. 100 crores, full assets recognized, full depreciation charge. Correct, not correct? Yes. So what happened? Assessing officer came and said, okay, pa, whatever loan was waived off for you is an income for you. So please pay tax. What M&M said? It's a capital receipt, therefore not taxable. It's a capital receipt, therefore not tax. Correct, not correct? Yes. Assessing officers, no. Forget capital receipt. There is a provision which says any benefit or perquisite arising from business, whether convertible in money or not, will be taxable as Pgbp. He said, yes, sir, I agree. This is a benefit or a perquisite, but it is not in money terms. Did I receive anything? I didn't receive anything. What did I do? I got a waiver of loan. I received money 10 years ago, but I waived it off today. I waived it off today. So when I received it 10 years ago, it was not a benefit. And today it is not convertible. Therefore, this transaction is exempt from tax. Supreme Court passed the judgment, came and said, yes, boss, correct. This transaction is not taxable for M&M. What happened? M&M paid no tax. KJCA transferred money to KJCA, free tax. Money moved from foreign to India, free tax. No problem. That is the only thing which happened in the middle. That the assets were transferred. In my feeling, I don't know the financials properly, but I think that they indirectly gave the assets back also. Adi eppadi pannanga theriyala, but pannanga. Yes, maybe one of the strategies I told you, block vechittu ella asset kuttru or asset mattum vechiko. Something they did. Yes, they will definitely not enter into the transaction simply like that. But the problem is, motto transaction got entered into, but nowhere anyone paid tax. Either M&M got double benefits because M&M did not pay tax on the waiver, but also claimed depreciation on assets. And High Court and Supreme Court came and said allowed. Now here is where the problem came. Income tax came and said, hey, what the hell is happening? You get asset also, you get waiver also, but you don't pay tax on anything. That's where the provisions were amended. And the provisions now came and said, whether in cash or in kind or partly in cash, partly in kind, it's okay. Meaning now, whenever there is a waiver of loan, it is mandatorily taxable in income tax. You cannot come and say it is not taxable. Now this is equally true now for banks also. Imagine that you have money which you are receiving from banks. And banks have decided they don't want to take back the money. They can waive off interest, they can waive off loans and everything. Now everything becomes taxable. You cannot let it go. Are you clear? Yes. This is your famous Mahindra and Mahindra case law. Any doubts till here? Good to go. Everyone understood this? Yes, you want to note this down? No? Leave it off. Point number 8 says any interest, salary, bonus, commission, remuneration due or received by a partner from its partnership firm. Now this is the more disputable area. Normally people come and say salary is taxable under salaries. But here is an exception where I'm coming and saying salaries will not be taxable under salaries but will be taxable under Pgbp. Reason, people? For you to be taxing something under salaries, there should be an employer-employee relationship. Between a partner and a partnership firm, there is no employer-employee relationship and therefore it becomes taxable under Pgbp because the partner is entering into this transaction for his own business purposes, for his own business benefits. But there are certain conditions where they say it is exempt only to the extent of 40B. That is what we'll be discussing subsequently. Yes. So I am coming and saying any salary or remuneration happening between partners and a partnership firm will become taxable under the head Pgbp. Clear? Yes. Any sum paid under an agreement for not carrying out any business or profession, which we commonly call as non-compete fee, or for not sharing any knowledge, know-how, patent, copyright, trademark, license, whatever it is of similar natures, will be taxable under the head Pgbp, provided they are not treated as a capital asset and taxed under capital gains, which means this is an exceptional rule. If it is taxable under capital gains, it will be under capital gains, but if it is not, then you will bring it under Pgbp. This is a very classic simple case where I'm saying if you do enter not compete fees. Yes, normally this happens between employer-employee. Yes, when you are into a very big research entity and all, they will normally put a clause to you and come and say that after you quit my company, you should not work in the vicinity for a long time. Yes, those are all non-compete and generally for that compensation will be given. Now, if it is a compensation given under salaries, it will be taxable under, meaning if it's a compensation given to employees, it will be taxable under salaries. But if it's a compensation given to a third party, then it will be taxable under Pgbp. That is what the premise is. Yes. Brings you to the last few items. It says amount received under a keyman insurance policy. What is this? Insurance taken for the KMP of the person. Okay. So what? What is sum received in Artham? What money will you get back? Keyman insurance policy is an insurance policy which can be taken on big shots of the company, like KMPs, for two reasons. Either the person dies or the person leaves. Yes, take a simple example where tomorrow what happens is Elon Musk decides to quit Tesla. The moment he makes a decision, Tesla shares will increase or decrease? Decrease. Business will fall. Business will crash. Yes, the moment the business crashes, what will happen? Every employee will take a hit. Business itself will take a hit. You would have learned it in foundation. There is something called as insurance accounts. Share of profit or loss from insurance accounts. Maybe it is not there as part of this syllabus. It was there in the old syllabus. Yes, where they'll tell you how to do average clause and all those things. Yes, point is, people, if you take a Keyman insurance policy, who will pay the insurance premium? Company will pay the insurance premium. Who will get the money back? Company will get the money back. So they said the company which paid the money will get the money back and therefore should be taxable under Pgbp. But please understand, this is again an exception to the rule to say that it will only be taxable under Pgbp if it is not given to the family members. It is not given to the family members. Sometimes when the Keyman insurance dies, the first insurance is taken for the family. So which means the family will be remunerated first. In that case, I will not tax it in the hands of Pgbp. I will tax it for family under IFOS. I'll tax for the family under IFOS. Clear? Clear? Last few items, people. Last few items. It says fair market value of inventory, which is converted from inventory to capital asset. Classic case which you have discussed in the past also. Conversion of capital asset into stock in trade and vice versa. And vice versa. Income tax comes and says treat FMV will be taxable. Treat FMV will be taxable. Further discussion on this when we do capital gains. Yes. Last item. Any amount received demolished on 35 AD assets. 35 AD is your specified business assets. Specified business assets. The provisions come and say that when you have a specified business asset, you should hold the asset for a period of 8 years. If you decide to not hold the asset for a period of 8 years, but internally make a transfer, to the extent the depreciation should be allowed, will be ignored. Everything else will be treated as an income. That is what this is. That is what this is. When we do 35 AD, that time we'll discuss. That time we'll discuss. Clear? Clear? That brings you to the extra explanations of the Income Tax Act. The explanation number 1, which has been introduced as an amendment in the current year, comes and clarifies that any kind of person who is letting out his residential property, any kind of person who's letting out his residential property will now be fully taxable under the head HP and not under PGBP. Even if he comes and proves that it is his business. Even if he comes and proves that it is his business. This decision overruled the judgment of Chennai Properties and Royal Corporation. It overruled the judgments of Chennai Properties and Royal Corporation. The background of the case is like this, people. There was a decision called Chennai Properties and Royal Corporation, where what was happening is these two entities were in the business of letting out houses. And therefore were offering the whole of the income under the head PGBP. Assessing officer came and said this is a house and has been let out and therefore should be taxable under IFHP. The reason why person would put it under PGBP and not HP, people, because you can claim all expenses here, whereas you will only get 30% reduction there. So what Chennai Properties happened is they took the whole of the revenue and put it under PGBP and taxed it at 70%. 30% reduction kudutadukku appuram. They filed an appeal and they came and said, sir, my business itself is to let out houses. If you come and say my property's income itself is going to be taxed under HP, then I don't have a financials itself to prepare. What is the point of me preparing a financials? Because everything which you say is telling under HP. That is when Supreme Court passed a judgment in the Chennai Properties and Royal Corporation, where they came and said, if the MOA, Memorandum of Association, and the AOA, Articles of Association, comes and clarifies that your business itself is to let out properties, then it will be taxable under PGBP. Now the fun what happened is the moment they brought this amendment, the moment the judgment came, everyone else amended their MOAs and AOAs. And they now introduced an additional clause, object clause left. They came and said, also permitting incidental rentals of properties. And everyone started offering it under PGBP in order to claim higher benefits. To avoid all those things, current year Nirmala ma'am came and said, you know what, get lost. Going forward, if the property is residential property, you tell me it's your business also, I don't care. It is now going to be taxed under HP. Meaning now you can only tax something under PGBP provided it is a commercial property like malls and all those things. If you have those kind of properties, office space, malls and everything, then it will be taxable under PGBP. But if you are going to let out a residential property, it becomes taxable under HP. Yes or no? So now if you come and ask Chennai Properties and all, is screwed. Gone case only, because Motta financials are now taxable as HP. But the problem with this amendment is, it's a very vague amendment. Because the amendment does not tell you what is a residential property. Yes or no? No. I'll give you a simple example, people. Imagine those cafes and all which you see in this Bhavans ke pakatla. You know Bhavans? On the, what road it is? Taylor's Road pakatla. Yes, if you see the new cafes which has come there, Soul Garden Bistro and all those cafes, technically all those cafes are made out of houses. Yes or no? It was a house, but the house owner decided to make it into a cafe. Now is now running a cafe there. Now the question is, Rahul, should I look at it as residential property or should I look at it as a commercial property? Because understand, the owner of the person did not decide that he wants to make it Soul Garden Bistro. The owner who gave the property had the property as a house. The tenant of the property has made it a commercial property. The tenant of the property has made it a commercial property. Tomorrow if Soul Garden does not run, what will he do? He will repaint the walls and make it a house. Correct, not correct? So here is where the question is, Rahul, when you speak about residential property and commercial property, do you look at it from the eyes of the owner or do you look at it from the eyes of the tenant? Correct, no? Correct, no? I'll take an example, people. Imagine that you're a share broker. Imagine that you're a share broker. Do you generally work from office or do you work from house? You normally work from house because you need a laptop in front of you. Imagine you're a gaming guy. And the headphones will upload a game pod. Yes, now all those people are all working from home. When they took the house on rent, it was a residential house. But what stops him from coming and telling that I'm using it for my business purpose? Yes or no? Yes or no? Now, the problem is not for the tenant people. The problem is for the owner. Problem is for the owner. Tomorrow, it may so happen that the owner may have given this property as a commercial property. But the tenant may be using it as a residential property also because there is no business happening there. Because there is no business happening there. In that case, will the owner come and tell it under HP or Pgbp? Yes or no? Yes or no? At the same time, if you come and tell, no, I'm giving the decision in the hands of tenant, then the tenant will use it for whatever purpose. And the owner will come and say, yes, sir, any person who's living in the house will also do commercial transactions also. In today's India's world, everyone is having a phone. Veetlo kanda ella business dealing I know. Which means owner can come and say, sir, he's sitting in the house and he's doing business dealing. So therefore, this is a commercial property. Correct, not correct? For you to classify something as commercial, residential property, you should also define what is a residential property, which has not been done. Which means this area is clean from litigation, open for litigation. Such huge litigation issues. If you come and ask me, Chennai properties can today screw them again. Go file an appeal. Come and say, sir, every person I gave the property is using it as commercial only. Because every Tom, Dick and Harry is sitting at home and making some money. Yes or no? Yes or no? The summa amendments you brought in and you think everything will get sorted, nothing will get sorted. Yes, things will still become ugly only. That is what the whole point is. Yes or no? Yes or no? Things for you to think about, people. Yes? 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 Anyway, this is what the definition of Pgbp is. This is what the definition of Pgbp is. Yes? On a high level, Rahul, from an exam perspective, what and all items do you need to keep in mind? Any benefits or perquisites? Any termination or modifications? Any salary given to partners? Any salary given to partners? And then the case law which I spoke about, the case law comes and says where the assessee had to deposit margin money with the bank for creating a bank guarantee, without which the assessee could not have won the contract for doing business. Whatever is interest which is derived from the deposit money will be taxable under the head Pgbp and not under head IFOS because it is exclusively for the purpose of business. It is exclusively for the purpose of business. Clear? Clear? Case law number 2 comes and says any kinds of fertilizer bonds given by the government of India in lieu of government subsidy, would be treated same as subsidy. Yes, what happened here, people? What happened here? Government went to a person and came and said, I have to give you subsidy. Instead of me giving you a subsidy, I gave you bonds. I can give anyone. Grants can be given in the form of cash or in kind. So I gave you a fertilizer bond. What you would have done with the bond? You would have taxed it as Pgbp income. Any grant you receive, you have to tax as Pgbp income. Correct, not correct? So he did what? He took the bond and taxed it as Pgbp income. Tomorrow he decided to sell the bond off. And unfortunately made a loss against it. Decided to disclose it under Pgbp. Assessing officer came and said, boss, the bond which you sold is a capital asset and therefore the loss should be a long-term capital loss or a short-term capital loss. Why, people? Because capital losses can be set off only against capital gains, whereas Pgbp loss can be set off against any head other than salaries. So assessing officer said, this is a capital loss, no set off permitted. Carry forward the loss. Pay me tax this year. Tell me, Rahul, correct, not correct? Not correct, because when the income itself is recorded as a revenue, the loss also should be recorded as an expense. And therefore the court came and agreed saying that it's a business loss. Correct, not correct? Yes, read, it says fertilizer bond given by government of India in lieu of government subsidy would be treated as a subsidy. Hence, any loss from the sale of bond will also be allowed as a Pgbp loss and not a capital gains loss. Agreed, not agreed? Agreed, not agreed. If you ask me, I don't agree to this. I honestly don't agree to this. Tell me why. Not really. Think about it, people. Imagine if the government had given you an asset. Government had given you an asset, a depreciable asset. What you would have done? You will reduce it from the asset cost, or at the end of the day, you will offer it to income. Either way, it is getting asset. Either way, it's getting an asset. Tomorrow, if you decide to sell this asset, what happens? You tax it under capital gains only. Why did it change from bonds to an asset? The nature is the same only. There you call it an asset, here you call it as bond. Both are the same thing. Here it's an investment, there it's an asset. Nature is the same. Yes or no? Where there you are coming and saying that you'll offer it to income, but you'll still tax it under capital gains. It doesn't make sense that here you'll come and say I'll offer it as income, but offer it as Pgbp loss. Hey, agreed, not agreed. Looks weird. Looks weird. It defeats the purpose. At the end of the day, it defeats the purpose, because income tax comes and says whenever you receive a benefit under Pgbp, you'll tax it under Pgbp. But if it's an asset, when you sell the asset, it's going to be a capital gains only. Bonds is an investment. What is the entry you will pass in the books? What is the entry you will pass in the books? You'll pass an entry called P&L account debit to. P&L account debit to fertilizer bond account. Where will the account go in it? Asset side only. Investments mein. Correct? No. Will technically hit your investment side only. और कहाँ बैठेगा वो? Yes. If you ask me, I don't like the decision. I don't like the decision. It was in favor of assessee, therefore I am not questioning it so much. But technically, this is a very wrong decision. Because if you ask me, if you take this decision in mind, I can come and say now any asset is taxable under Pgbp only. If I am the assessing officer, I will use the same decision. I will come and say when a government gives you any asset, when you sell that asset, it will be taxable under Pgbp. Straight or solid one. That time, no one will come and question. Correct, not correct? Yes. A decision which is a little controversial decision can be overruled. Definitely can be overruled, but somehow it is not. Somehow it is not. It's a Supreme Court decision, I think. It's a Gujarat High Court decision. Gujarat High Court decision where they came and said PCID versus Gujarat State Fertilizers and Chemicals Limited. It was basically a bond given from government to government company. It was a bond given from government to government company, and therefore somehow they won it. Basically, government given to government company, fighting with government only. All playing together. Yes, group up. Some nonsense happened, and therefore something went wrong. More from an exam perspective, people, not so much critical from a practical standpoint. Yes. Sorry. He paid, no, he would have offered it as income to tax. Okay. Huh. Okay, put it this way, Sehul, when you got the bond, you got a bond of 100 rupees. But technically, did you get money? Did you use the bond for anything? So when you sold the bond, you got only 50. So technically in your hand, how much more money did you make from the bond? You never made 120, you made only 50. You were supposed to, right? Subsidy? Okay. Okay. See, that's technically true, right? That's technically true. When you say you never incurred a loss, I am saying that you never incurred a loss from a book's perspective or a practical perspective. But from an income tax perspective, you incurred a loss. Because from an income tax perspective, you offered 100. Whereas you should have offered only. Think about it. When you were supposed to offer only, how much did you get in your hand? 50. Overall from the whole transaction, you should have offered only 50. But how much did you end up offering? 100 first. How much did you end up resulting in getting? 50. So technically you should get back the 50, right? So 50 का लॉस तो होगा ही होगा. The only question is वो 50 का लॉस कैपिटल गेन्स में डालोगे या पीजीबीपी में डालोगे. That is not going to change the fact. Think it from that perspective. Clear, people? Yes or no? Yes. Two case laws for you to keep in mind from an exam perspective. One is that if you are going to have any interest earning from a specified account which is created only for the purpose of business operations, then it will be taxable under PGBP and not under IFRS. Second, if you have a bond which is being offered as tax for because of grant, if you sell the bond and you get losses out of it, you will have taxed it under PGBP again. You will have to tax it under PGBP again. Good to go? Good to go? Yes. Now, Rahul, from an exam standpoint, do you have to read all this? Definitely no. Don't do that. Don't do that. Case laws, this will be useful for your full-fledged question. Will be useful for your full-fledged question. They may give you an additional information, and the additional information may come and say interest received from a account which is created specifically for a contract, specifically for a contract. You will have two choices, either put it under IFRS or put it under PGBP. Answer will remain the same only. Total income will not change. Disclosure alone will change. So to that extent, focus on this only from a disclosure perspective. Focus on this only from a disclosure perspective. This will not come as a full-fledged case law question. Yes, these kind of questions don't come as a full-fledged case law question. They come as a disclosure level question. So focus only to that extent. Clear? Clear? So which means I don't expect you to remember the case law name. I don't expect you to read English, write big English. No. It is enough that you know the disclosures properly. Clear to go? Can we go forward? Yes? Great. Now, here is where the things change. I am now coming and saying, you know what is a business and a profession. You also know what is profits and gains. You have profits and gains. Income tax comes and tells, Rahul, once you have understood what are your business and you have understood what is your profits and gains, do me one small favor, Rahul. Split your business into two categories. One category is called as speculative business and the other business is called as non-speculative business. Now, on a high level, people, without going into definition, what do you think speculative business is? Examples nahi pucha. Meaning, any kind of income derived from a transaction without having an underlying asset. Is called a speculative business. Examples are F&O tradings. I would still not say intraday trading because please understand, at least in India market, it is not permitted. When I say not permitted in the sense that even if you do an intraday trading, assets will come to you, then go out. The T+3 mein, assets will come to your account, then leave your account. So technically assets are coming, right? That's called long and short. That's F&O. That is what we call F&Os, right? So basically I'm coming and saying that, Rahul, if you enter into F&O transactions where there is no transaction of underlying asset, in that case it will become taxable under business as a speculative business. Now, Rahul, what is F&O and everything? I will not tell you. You will learn it in AFM. You have a subject called as foreign exchange. What is it called as? No, this chapter name is called as, forgot the name. It's been a while. Derivatives and all topics in the chapter name, some international something. It's called something like that. Yes, where you learn about futures, options, hedging, butterfly hedging, manual hedging, pata nahi kya hedging hai. Then one more, futures, options, forwards, and then there is something called as arbitrage is a concept inside it. The case where you don't even trade anything and you just randomly go moving around and do things. I don't know what it's called. Money market instruments. Those are the kind of items. You learn all this in AFM, people. If you have not started AFM, start. That's a subject which you will never understand. Yes, there are too much in the subject to understand. Anything which you have not done. Everything is there in the subject. Yes, the only two chapters which you can probably understand in the subject is called as mutual funds and capital management has moved to Inter, I think. Capital budgeting. Yes, these are the only two chapters you will understand. Other than that, nothing you will understand. Utru. Yes, these are the only two chapters which probably you will understand. Okay, probably you will understand. Okay? The other chapters you won't even understand because now they're talking about foreign management, foreign assets, foreign options and everything. For you to understand those things, you should have actually started trading and everything. Then only you can make sense of it. From an exam perspective, focus on the formulas, mug up the formulas, vomit the formulas, come and pass, that's all. Yes, that is what I did, at least for my AFM, nothing else I did. Yes, AFM lab, I did one thing. I basically took some last 10 attempts paper, compiled all the questions, solved all the questions, and then in exam, 5 of the questions came. So I passed. Simple, straightforward. Yes, nothing else is coming in exam. And they have this thing where one tough question will come. And that one tough question is not something they would have prepared. It's basically from one of the past papers, that's all. So if you can go to a faculty, you can prepare a compilation book. Some faculties will preach. Some faculties will preach that I'll prepare a compilation book where you will have the past exam papers, past RTPs, past MTPs, everything I'll cover and go. Go to that faculties. Not for the teaching, for the book. Go to that faculty, get the book, mug up the book and go for exam, you'll pass. That is what you can do for exams. Good thing about that subject is there is no theory, there is no provision. You just have numbers, put the numbers, get the answer, put the numbers, get the answer, put the numbers, get the answer. Yes, that is what AFM is. No wonder SEMP is removed. No one understood that subject itself. That is even worse. Yes, some costing and all, I don't, transport costing and what costings and all you had? Worst topics I tell you. Standard costing, budgetary control and transport costing, operation costing, operating costing, process costing, in the costing, on the costing, accounting costing, cost control costing. Accounting la costing vera. Enike purila, accounting a costing a. Yes, income tax itself is complicated, people. Why do you want other subjects in life? Yes, let's focus on this one. This is better at least. Yes, point is, people, you're looking at businesses. 2 businesses are covered. One is called a speculative business, one is called as non-speculative business. On a high level, basically, I'm coming and telling that if you enter into transactions where there is no underlying assets being sold, meaning in a simple, very simple nutshell, it's a transaction where I'm coming and saying that, you know what, I am expecting 100 rupees of this asset. I am expecting 100 rupees of this asset. Now, what happened is I am looking at the market. The market is quoting 80 rupees. I have a feeling that the asset will go for 100 rupees. I have a feeling that the asset will go for 100 rupees. In a very, very layman terms, I am going and betting. In a very layman terms, I'll go and bet. I'll go to a random person and come and say, boss, I want to sell this asset to you for 100 rupees. I want to sell this asset to you for 100 rupees. He will come and say, boss, price is showing 80. I'm like, I bet that it will go 100. I bet that it will go 100. What will the other person do? He will bet back and say, no, it will not go 100. He'll bet back and say, it will not go 100. Now we both are betting. We both are betting. Assuming it hits 100, I make 20 profit. I make 20 profit. It does not hit 100. He makes 20 rupees ka profit. He makes 20 rupees ka profit. At the end of the day, we only bet it. We never gave the asset. We never gave the asset. This is like basically going and saying that if you go to a cricket match, you come and say, today India will hit 300 rupees, 300 score. Today India will hit 300 score. If India hits 300, I will get 1 crore. If India does not hit 300, you will get 1 crore. Simple betting. Now, it's not like just because we're paying 1 crore, Dhoni will come to my house and sleep my house. He will not come and sweep my floor and all. Yes or no? This is basically me betting at the no underlying asset. With no underlying asset. Now, in all honesty speaking, all those bettings are also speculative business. The only problem with India is they are all illegal. They're all illegal. You're not supposed to do. You're not supposed to do. So, no one comes and declares saying that, yes, I betted on India and I got money. Not happening. Yes, the only thing which is legal in India to do betting is futures and options, or what you now famously call as Dream 11, legal cricket betting. Yes, pura illegal only, but betting, that is what it is. Yes, that is how the ones work. Point is, income tax is coming and saying, Rahul, you have 2 kinds of businesses. One is speculative business, one is non-speculative business. Answer me a simple question. You enter into such F&O transactions. You enter into such F&O transactions where you're betting life. Where you're betting life. Chances of making profits, huge, less. Chances of making profits, huge or less? Huge. Chances of making loss also, huge. Yes or no? From an income tax perspective, if you make more profits, I'm happy. But if you make huge losses, I'm also concerned. Yes or no? Yes. There was a time back in 1990s and all where what happened is that time only share market was growing. You would have seen a lot of old movies and all. They will come and say that I've taken money from my dad's account and I put it in shares. Ella mein thotitan solte. Arshad Mehta times. Yes. Basically, what was happening is in those areas and all, people were doing normal businesses, making profits, and suddenly taking all the money and putting in shares, making losses, making losses, and then came back to income tax department and came and said, we made profit here, we made losses here, set it off, and therefore no tax. Set it off, and therefore no tax. Here is where income tax stood up and they came and said, boss, first of all, you were doing a good business. You could have left with that. You could have lived with it. Unnecessary bringing that losses, making sure that you don't pay taxes is not the way to go. It's not the way to go, because that you did out of hobby. That you did out of hobby. So if you have a loss from a hobby, you should have profit from a hobby to set off. Have a profit from a hobby to set off. Yes or no? Yes. Here is where income tax came in and said that, Rahul, we will split our businesses into two categories. One is called as speculative business, one is called as non-speculative business. Income tax said, if it is non-speculative business, this is your hard-earned money. You get losses, great. You get profits, great. I don't care. I don't care. But if you are running a speculative business, if you make profits, I am happy. I am happy. But if you're making losses, I am extremely disappointed. I'm extremely disappointed. Disappointed to the extent that I will come and say that if you make a loss on speculative, you can only adjust against your speculative profits. You can only adjust against your speculative profits. If you have a speculative profits, you adjust. If you don't have, you can carry forward. You can carry forward for a period of 4 years, provided the return is filed before the due dates. The return is filed before the due dates. Yes or no? Yes. Again, Rahul, what is the high level provisions? The provision comes and says, when you have a speculative business, any losses from the speculative business can be adjusted only against speculative incomes. If there is no incomes, you will carry forward for a period of 4 years, provided the return is filed on due dates. Return is filed on due dates. This is what the provisions are. Section 43, subsection 5. Section 43, subsection 5. Yes or no? Yes or no? This is what the idea is. Any doubts, Liam? No? Now, on high level, not from exam perspective, on a high level, what do you mean by speculative business? Income tax has notified it. Income tax is notified it. Income tax comes and says, speculative business means any transaction in which a contract for trading, including stock and shares, is settled otherwise than by actual delivery or transfer. So there should be no underlying asset in it. If that is the case, then I'll give you the speculative business. But then they also gave in certain exceptions, where they came and said these transactions will not be called as speculative businesses, meaning they are normal business, meaning losses from this can be set off against any incomes, other than salaries. Yes. What are the items, Rahul? Same AFM. I'm not teaching it to you. What are the items? It is hedging. On a high level, people, what is hedging?
Exchange rate fluctuations.
People, I don't want broken English. Give me English. Things which I understand. What are you doing in this? That is futures. That is futures and forwards. That is what is forwards and futures. Hedging is a case where you don't do any of those, people. It's basically a case where you're coming and saying 3 months later I want to buy a raw material. I will come and promise him that 3 months later, whatever is the price, I'll give it to you. Meaning today the value may be showing 100 rupees. 3 months later it may show to 120. I will pay you 120. If it shows 90, I will pay you 90. Meaning I'm taking complete risk on loss. 120 acha loss, 90 acha profit, gali. That's all. Meaning I'm not fixing anything today. The day when you today fix it, saying that no, I will buy it to you from 3 months later at 110. Now I have fixed it. Those are called as forward contracts. Hedging contracts are simple contracts where I'm coming and saying I will enter into a transaction with you today, and I will pay you whatever the market price is 3 months later. 3 months later. Hey, people, hedging contracts, risky, not risky. Extremely risky, because it can jump or it can fall. You never know. Both are risky. That is why if you notice, it's not hedging contracts on shares. It is hedging contracts on raw materials, there's shares also there. Hedging contracts on raw materials and merchandises, where I'm basically coming and telling it is hedging for your business reasons. Because then it's okay. You're okay to make losses in your raw materials. It's fine for you. It is fine for you. Yes or no? Yes. Point number 2. That's what I told you. Today itself, I decide that 3 months later, I'll pay it to you for 110 rupees. Meaning, I know that no matter what price it is, I will pay you 110. Which means today itself, it is decided that my loss is 10 rupees. Today itself, it is decided that my loss is 10 rupees. Now there is no bet. Now there is no bet. I am not betting on anything. I'm not betting on anything because it is agreed that I will take a 10 rupees ka loss no matter what happens. No matter what happens, and therefore this is a non-speculative transaction. It's a genuine transaction. It's a genuine transaction. Point number 3. Trading in. What is derivatives, people? Everything which you discuss right now is derivatives only. Yes, derivatives is a bigger English. Derivatives is a bigger English. Under that falls forwards, futures, options, hedging. All those things are derivatives. All those things are derivatives. Next. Commodity derivatives, with the condition that you are going to pay CTT on this. With the condition that you are going to pay CTT on this, meaning this should be a derivative transacted on a stock exchange. It should be derivative transacted on a stock exchange. You should not be doing outside the stock exchange. If you're doing it outside the stock exchange, I am not permitting it. I'm not permitting. Then you're betting only, basically. Then you're straightforward betting. If you do it on a stock exchange, then it is regulated by SEBI, and therefore it is legal. And therefore it is legal. Any other bettings outside the stock exchange are not permitted. But then what happened is about 3 years ago, there was a decision which was made by SEBI, where SEBI came and decided that if it's agricultural commodities, I don't want to collect CTT itself because I want to promote the trading. Now here is where what the problem happened. The moment SEBI decided that CTT will not be paid, assessing officer came and said, okay, going forward, agricultural commodities are speculative. Understand, that was not the intention. And therefore, they brought in an amendment later on where they came and said, if it is agricultural commodities, it is okay even if no CTT is paid, as long as it is transacted on a stock exchange. Yes or no? Yes. Now, Rahul, from an exam perspective, what do you have to read? Just the point number 4. There is one question in exam very long back which has come where they have come and told agricultural commodities on which CTT has not been paid has incurred a loss of 5 lakh rupees. What is the accounting treatment? What is the income tax treatment? You will treat it as a normal business loss and set it off against your business incomes. Are you clear? Yes. Now, question, Rahul. I am coming and saying that, Rahul, I have a speculative loss and I have a business loss. I have a speculative loss and I have a business loss. My speculative loss is 2 lakh rupees and my business income is 5 lakh rupees. Current year, my Pgbp is, people, current year my Pgbp is 5 lakhs because speculative only against speculative income. Therefore, the income becomes 5 lakhs. The 2 lakhs will get carry forward. Agreed. Second case, I am coming and saying my speculative is having 3 lakhs. My business is having 2 lakhs. My Pgbp is independent scenarios. My Pgbp is 3 lakhs or 1 lakh? It is 1 lakh because business loss can be set off against any income other than salaries, and therefore it gets set off. Correct, not correct? Yes. Please bear this in mind, people. The restrictions are only from loss of speculation perspective. There is no restriction on business perspective. Business loss can be set off against speculative profits. Correct, not correct? Yes. Option number 2. I am coming and saying, Rahul, I have a capital gains loss of 4 lakhs and I have a speculative profit of 10 lakhs. My Pgbp is because a capital loss can be set off only against capital gains, and therefore this again gets carried forwarded, which means my income sits at 10 lakhs. My income sits at 10 lakhs. Correct, not correct? Correct, not correct? Rahul, I have a business loss of 3 lakhs. I have a business loss of 3 lakhs of assessment year 24-25. I have a business loss of assessment year 24-25. Current year, I have a speculative profit of 6 lakhs. Assessment year 25-26. Tell me what is a PGBP? You understood the question? Understood the question? Yes, last year's business loss. Current year I have speculative profits. Can I adjust, not adjust? Allowed 8 income 6 or 3 6 or 3 quick it is எல்லாமே தெரிய மாதிரி பேசுனீங்களே it is 3 lakhs. Hey people, speculative profits are nothing but business income, and business loss can be set off against any business income. Any business loss can be set off against any business income. If you are going to put speculative profits under PGBP, then technically it is eligible for set offs in the future also. When you can do it in the past years, you can do it in the future also. There is no difference there. There is no difference there. Classifications are critical. Classifications are critical, which means set offs are permitted. Set offs are permitted. Clear? Hello? Note down. இதெல்லாம் மறந்துடுவீங்க, இப்போ தெரியும், எல்லாமே மறந்துடுவீங்க. Hey, take out your sticky notes. Second scenario, 3 lakhs speculative profit, 2 lakhs business loss. No, independent questions. They're not linked to each other. It's not year 1, year 2, I'm saying. Independent scenarios. People clear? Yes. Yes, please bear in mind that when it comes to speculative losses, speculative loss can be adjusted only against speculative incomes, but the same is not true from the reverse scenario. It's not true from the reverse scenario. Business loss can be set off against any business income, and when you say any business income, speculative is also covered inside it. Speculative is also covered inside it. Clear? Yes, yes. Can we go forward? Great. Now, in the interest of time, I'm not going to be spending time and doing Pgbp today itself. Let me take some time and only give you the high overview of the Pgbp format. Yes, the one bigger mistake which I see most of the people making from an inter and final perspective is that they don't know how to approach a question. Yes, especially from a Pgbp perspective, because when they look at an adjustment, they somehow become a little complex about how to take this up. Yes, and therefore let's think about it as a very layman person. Let's think about it from a very layman perspective. What I'm going to do is I'm going to prepare the format for you right now. Yes, if you notice the format is given under section 29, where it comes and says how does Pgbp look like? How does Pgbp look like on a very high level? On a very high level, income tax says do one thing. I'm giving you two options. Either you can follow direct method or you can follow indirect method. What do you mean by direct method, Rahul? You start from revenue and then claim expenses which are allowed. Claim expenses which are allowed, and you find your Pgbp. Indirect method says you start from net profit, disallow expenses which you cannot claim, and add incomes which you should have offered. Add incomes which you should have offered. In a practical standpoint, normally always people do indirect methods. Yes, because that's what I did. No, when I started your financials review also, I told you start from net profit before tax, and then we did some disallowances and checks. Disallowance and checks. So Pgbp also works in the same fashion. They come and say you do one thing. You start from net profit. You start from net profit, and then you add some things and you reduce some things. You add some things and you reduce some things. Now what I normally do is I call them into 4 English. I call them into 4 English. You add 2 items and you reduce 2 items. And you reduce 2 items. You add 2 items. First item is called as disallowance. Second item is called as additions. You add 2 items. First item is called as disallowance. Second item is called as additions. You reduce 2 items. One item is called as allowance. Second item is called as reductions. Second item is called as reductions. Take a minute, people. Look at the 4 words and tell me what is the difference. That is, so disallowance is when it is claimed in accounts. It is claimed in accounts, but not allowed in tax. Very good. Huh. Addition is, it is not in accounts, taxable in tax. Taxable in tax. Allowance. Not there in P&L. Allowable in tax. Taxable in accounts, not in tax. For English people, yes. Now, if you understand this 4 English, your technical Pgbp is over, because the bigger mistakes which everyone does is in these 4. Yes, the one mistake which people do is they don't realize what is happening in accounts before they start making decisions relating to taxes, and that's where the whole problem starts. That's where the whole problem starts. 4 words, and extremely critical words, people, even from an English perspective. Even from an English perspective, because this small mistake can make a huge change from your practical standpoint also. I'll give you a simple example. An example has come in a scenario where I'm coming and saying that, Rahul, any asset which you purchase, you have to deduct TDS under 194Q. Any asset which you purchase, you have to deduct TDS under 194Q. That is what the rules are. Yes. Section 40A comes and says that if you are liable to deduct TDS and you have failed to do so, the expenditure will be disallowed in the Pgbp. The expenditure will be disallowed in the Pgbp. Agreed, not agreed? Yes. Current year, I purchased assets worth 100 crores. Current year, I purchased assets worth 100 crores and did not do TDS on it. Did not do TDS on it. Tell me what happens in Pgbp.
To the extent the goods are consumed and disallowed.
Assets. 194Q will come. No, any purchase of assets is liable for 194Q. Goods includes assets. Sale of Goods Act. Both covered. People, I purchased assets worth 100 crores and I have forgotten to do TDS. This is a payment made to a resident. What is the provisions in Pgbp? What should I do in Pgbp? Sorry? Addition, because read 40A once again. I'm going to read the 40A for you once again. Provisions of 40A come and say, where an expenditure which is required to have a deduction under chapter 7B has been failed to do so, 30% of the expenses will be disallowed in the Pgbp. 30% of the expenses will be disallowed in the Pgbp. Section says to, you asked to, can you do so? When income tax itself is not asking, will you voluntarily do it? You voluntarily will not do. What is the mistake here, people? 48 talks about expenses which are claimed to be disallowed. Have I claimed? Can I disallow? That is what the answer is. Correct. Imagine getting this question in exam. What is the first thing you should do? You know it should be disallowed. For it to be disallowed, it should be first debited. Is it there a debit? Up or you will? Correct, not correct? Correct, not correct? Correct, not correct? Yes. Question number 2. Section 43B comes and says, any taxes paid should be paid before the due date of return filing. Failure to do so will attract a disallowance. Failure to do so will attract a disallowance. I have collected GST from my customers, forgotten to pay the money to the government. Forgotten to pay the money to the government. Treatment.
If I have claimed that as an expense because of wrong credit, otherwise not. Because if I have not
GST is there in the accounts, not there in the accounts. Is there in the accounts or not there in the accounts? It is not there in the P&L. It is not there in the P&L. When it is not there in the P&L, you cannot disallow. You cannot disallow. You can only disallow when it is claimed. For something to be disallowed, it should be first allowed in the accounts. In the accounts. Correct, not correct? Correct, not correct? Yes or no? Yes or no? This is where the whole change happens, people. And this is an important change from your practical standpoint also. Yes. Do not come and tell your client that, sir, 194 QL TDS pudi clan na nale disallow panidanga. For him to disallow, he should have first allowed it. And he never did that. He never did. Correct, not correct? Yes. Now brings the question of, I keep forgetting your name. You have a very nice name. Tisha. Tisha comes and says, Rahul, you would have anyway claimed depreciation, right? Why don't you disallow the depreciation? Why don't you disallow the Ask yourself, is depreciation an expense? Is depreciation an expense? No, it is an amortization of your asset cost. It is an amortization of your asset cost. And 40A comes and says you should have claimed expense. This is not an expense. If you go to section 32, 32 does not say depreciation is an expense. 32 says depreciation is an allowance. And there is a difference between allowance and expense, which means depreciation will also not be disallowed. Depreciation will also not be, correct? No, correct? No. The only thing which an officer can come and tell is, boss, since you did not do TDS, I will levy 201 interest. Apart from that, will you take a hit in your P&L? Will you take a hit in your P&L? No, you won't take a hit in P&L. Correct, not correct? Here is the same question, people. Unexplained expenditure. I came and told unexplained expenditure comes and says no deduction of expenses will be allowed. No deduction of expenses will be allowed. I paid a building rent. I paid a building rent. Put it in my P&L. And then officer said it is unexplained. What will I do? I will disallow because it is there. If I did not even put it in my P&L, I will ignore it off because it was never. You agree to what I'm saying? You agree to what I'm saying? Yes, this is the bigger problem with people. Yes, what they do is they go for 43B and they look at 43B, Rahul, payment agale disallow. They don't come and check whether it is claimed or not, first of all. Correct? No. Claim போட்டதானே வரோம், போடவே இல்லைன்னா என்னத்துக்கு வரோம்? Yes, I tell people always the best way to do Pgbp is first to prepare an accounts. Then ask yourself in the items length, what do you leave and what do you consider? If you are going to leave, you are going to leave. But if you are going to consider, that's when you decide whether it is disallowance or reduction, because those are the only items which are there in the P&L. Hey, hello. Yes or no? Yes or no? So what is the best way to approach a P&L, Rahul? Imagine in your head what happened in accounts. If it is there in the accounts, you will disallow all, reduce. If it is not there in the accounts, you will allow or add, provided you are supposed to do it. If you are not supposed to do it, you will ignore. You will ignore. Yes or no? Yes or no? One of the very beautiful questions which always ICI loves to test. They will give you a question. They will give you a question and the question will come and say the company, the firm has decided to follow cash book of accounting. The company has decided to follow cash book of accounting. Yes, company has proposed that the employees should be paid 1 lakh ka bonus. Company has proposed that the employee should be paid 1 lakh ka bonus in previous year 24-25. In previous year 24-25. Payment of which has happened on December 26. Payment of which has happened in December 26. Tell me what is the treatment. I'll repeat the question. Company is following cash system of accounting. In 24-25 has proposed to give bonus. But the payment of the bonus has happened in 26-27. 26-27. What is the treatment today? What is the treatment today? Because when the company is following cash system of accounting, expense will be booked in the year in which the cash is paid. And the cash is only going to be paid in 26-27, which means current year accounts has nothing. Accounts has nothing. And 43B says, if you don't pay, don't claim. And I'm saying I have not claimed, therefore I will ignore. Therefore I will. Correct? No. Correct? No. Correct? No. Yes, I'm coming and saying company has in the P&L offered something called waiver of loan as an income. Company has in the P&L offered something as waiver of loan for P&L. Tell me what is the treatment. You understand the question? You understand the question? Company has got a waiver of loan of 1 lakh rupee showing in the P&L in the credit side. Showing in the P&L in the credit side. What is the treatment? It is there in the accounts, in the income. Income tax says should be offered to tax. Has it already been offered? Therefore you will ignore it off. Correct? No. Correct? No. Correct? No. Yes, this is the one small thing which you have to understand, people. From an exam perspective, the problem with an exam perspective versus practical perspective is in practical perspective you have P&L, so you know what to do. In exam perspective, what they'll give paragraphs. They'll come and say net profit of the company is 10 lakhs, included in the above so and so items. Not included in the above is so and so items. Now you have to decide what to do with each. For you to do that, first you have to ask yourself, Rahul, Is it there in the accounts or not? If it is there in the accounts, then ask yourself, what should tax do? If tax says keep it in the accounts, then you have to ignore. If the tax says don't keep it in the accounts, then you will disallow or reduce. You understand what I'm saying? You understand what I'm saying? Yes. When I start this chapter, people, when I start this chapter, the whole provisions we are going to discuss will be with the assumption that it is there in the books. Because Pgbp is designed in the statement where they're coming and saying it is there in the books, therefore you disallow. Therefore you. Correct? No. It does not mean that every time Rahul comes and says disallow means you'll keep adding. It means that if it is there, you will disallow. And if it is not there, you will ignore it off. If it is not there, you will ignore it off. Clear, not clear? Clear, not clear? Hello? Yes, yes. Make a note of this and we close for the day. Put it next to section number 29. Put it next to section number 29. Done, everyone? Done, everyone? Yes, yes. From tomorrow's class, whenever I read a section, we will look for 4 words: disallowed, addition, allowance, reduction. We look for 4 words, people. Yes, every time we read a section, we look for 4 words, and then we'll ask ourselves a question: is it already there in the P&L or not there in the P&L? Then make a decision. Do not come to any position where you come and ask me to make an addition when it is a disallowance. Don't do that. That's a mistake. And that's something to be noticed from an exam perspective also. Yes, the one thing which I noticed from everyone who's from inter and final level, one standard line: payment is not happened before due date of return filing, therefore it is to be added. There is nothing called added and all. It is either disallowed or it is deemed as income. That is called disallowance, or it is called deemed as income. If for everything you keep saying the word added, then you will end up doing adding only. And then you will also add in these things which you should not have to add. So from tomorrow we'll change English. You will come and talk with me English terms, where you'll use the word disallowance, deemed as income, allowed, reduced from income. I will like to see this 4 English coming out of you every time we read a provision. Yes or no? Yes. Before tomorrow's class, small request, people, you will read up to page number 36. You read up to page number 36 from page number 1, people. Yes, read everything from page number 1 and come. Keep getting that used to book. When I start teaching you, people, I don't see the book and all. I teach it from my head. Yes, so you are still not getting used to reading the book. Get used to reading the book. This book should become a Bible for you, so that in exam times when you read the book, you know what you're talking about. Yes, come to a position where you should be able to photo memory the book itself. You should be able to tell Rahul Pgbp in the line in the color potting. Yes, if you come to that position, then yeah, exam will automatically come to you. Yes, so please, getting used to the book is more important. So please get used to the book. That is extremely critical for all of us. Yes or no? Yes, great. One small request from my side, people. Today is the last day of the demo, in the sense that from tomorrow the videos will not openly be available on YouTube. Yes, now you people don't have to worry. The only worry you have to do is, if you are not attending a class, you will have to drop me a message. The moment I upload the video, I'll share a link across to you. Yes, that is my only thing. You will not find it openly. So in case you sit silent and come and say, Rahul, I forgot to see it, therefore I did not get it, I will not share it. I will only share it in case you come and ask for it. Yes, the full lectures of the videos will be given to you when the batch gets over. Yes, until that time, you will be given individual recordings when you ask for it. Because the moment I give you the open playlist, I know what is going to happen. So I'm not taking that chance itself. Yes, I will give you all the videos. No problems here. You ask me and I'll give you a YouTube link video. You will get the YouTube link video on the same day itself for you to watch it. But only those videos which you ask for it. Daily basis, Rahul, எனக்கு புரியல குடுத்துருன்னா காலி பண்ணிடுவேன். That is not happening. That is not happening. But you will be promised to given the whole of the videos once the batch gets over, so that you can revise it once again also. That is what is happening. Clear enough? Yes, yes. So please feel free to reach out to me from tomorrow and I'll give you all the recordings to go. Yes. For you, Google Meet will start from tomorrow. Yes, I want to ensure that you are not sitting on YouTube and not able to ask doubts. So I will start Google Meets from tomorrow, so that if you have a doubt, you can reach out to me. You can speak live to me. So we'll do that from tomorrow for you. Yeah. Yes. Yes. For those who are planning to go for an audit, for those who are not available, for those who cannot come to a physical class, drop me a message. I'm anyway planning to do a Google Meets from tomorrow. So you'll be available to join on Google Meets from tomorrow and you can watch the recordings there. Only if you are traveling. If you sit at home, Rahul, எனக்கு போர் அடிக்குது, வீட்டு வரல, அதனால காலி. No. I will need an evidence that you're going somewhere before you get and ask for that permission also. He asked me a permission because I know he's going. Yes, get a permission, then only you're getting to do all those things. You will be permitted to do online classes when your season is going on. And I don't mean GST season. ठीक है? Yes, great. Thank you people. Have a good weekend.